everybody. Welcome. I know there are still a few people streaming in outside. Please come forward. There are a few seats here. Scoot in together so we can sit together nice and warm and cozy on a Saturday morning. Wonderful. Our first row is going to be for speakers, and then all the rows after that. Please fill in. Thank you. Did I see a little girl here? Fantastic. You're starting her early. I like it. I like it. Hello, sweetie. Hi. Okay. I don't want to make you cry. Ladies and gentlemen, a very, very warm welcome to all of you to the second day of the annual Endowus WealthTech Conference. If you were here yesterday by any chance, welcome back. My name is Anita Kapoor, and I'm going to be your host and your guide and your MC for today, and I'm super, super thrilled to be here with all of you. Whether you're joining us in person in the room, thank you so much for being here and being punctual, or you're joining us virtually, hi to our virtual audience as well. I am also an Endowus client, and if you've been watching the videos, I hope you have, I'm the one who shouts really loudly. So yeah, that's me in the pink dress. And this makes it a very, very meaningful and very special day for me to be here today. You know, we've really got a very extensive lineup today covering a really wide array of financial topics, and I'm going to be learning along with all of you today. So just a show of hands, really, who's kind of looking to enhance investment knowledge here in the room? It's pretty much everybody. Oh, those people aren't, no, they're not, okay. Gain insights into different asset classes. Demystify the complexities of CPF and SRS. That's all of us. And of course, alternative investments, right? Fantastic, because we've got you covered for all of that. And I also understand that many of you may have your own personal burning questions, okay? So our speakers are here to answer those questions for you. Please head over to Slido, slido.com, and use the event code EWC2023 to send in your questions. We also have mics in the center of the room for the rest of us who are not so shy to face the panels here. So please, of course, get those questions ready. There will be periods of time for Q&A after all of our panels. If you're excited to share on social media, please do. We love when you share on social media. Tag us at Endowus and use our official hashtag EWC2023. We also have 3 lucky draws today, and my gosh, these prizes are great, and I will not be able to participate at all. They're worth more than $4,000. A gentle reminder that you need to kind of be in the room here. So if you actually stepped out to go wash your hands, sorry. But stay on, of course, with us. We have a great day ahead, and we have those wonderful prizes too. Before we begin properly, a really big thank you to all of our partners today for making this day possible. Our platinum partners, Amundi, Dimensional, Franklin Templeton, UBS Asset Management. Our gold partners, BlackRock, New Berger Berman, Schroders, and T. Rowe Price. Our official knowledge partner, and they have so much knowledge as was demonstrated yesterday, McKinsey & Company. Additionally, of course, our heartfelt thanks to our supporting media partners, Singapore FinTech Association, Family Office Association Hong Kong, and FinTech Association of Hong Kong. Okay, I got all the official stuff out of the way. Today's conference, of course, as you know, is brought to you by Endowus, and I'll be bringing our co-founder on stage very shortly to say a few words. But first, a short video on the Endowus journey. Please watch. Ladies and gentlemen, please give a very warm welcome to the Chairman and CIO of Endowus, Sam Rhee, to share a few words. Sam, the stage is all yours.
Thank you, everybody. It's so wonderful to be here. Thank you, Anita, for opening us up. I just want to say there's spaces in the middle, and I think there are people standing and looking for seats. If everybody can scoot in, if there's an empty seat next to you, if you're going to be considerate to others and just scoot in, make space. There's some space up front, guys. There's some space here as well. If you can just make your way in, that'd be fantastic. Thank you so much. If you can just scoot in, if you have a space next to you, yeah, find space. Feel free, don't be shy. You guys watched some videos about our advocates, and if I can just start with the slides. Yeah. We began this journey about 6 years ago, and Endowus is a passion project. It's a love project for us because we built it for ourselves and for you, and our loved ones, our families, our friends, people like Anita and our advocates who are our clients, because we felt there was a big gap in the way wealth was being serviced and we were being serviced. So we are here, Endowus is here, to really empower individuals, families, so that we can invest better to live better. Because there is a difference between saving money and investing money. And if we don't get the right advice, and we don't get access to the right type of products, investment products, and the cost is too high, the outcomes are already set. It's going to fail us. So we need to do better, and investing better will really help us to live better as well, because it frees us up to give us more time to do the things that we are passionate about, the things we love, and spend time with our little loved ones like here. So, wonderful to have you today join us. And we're really about three things, the three most important building blocks for success when it comes to investing. It's advice, it's access, and it's cost. If you take nothing else from this, it's advice, access, and cost. And that's what you measure success as you shop around and say, okay, which is the right financial service provider that's going to help me succeed? Are they giving me the right advice? Is it conflict-free? Is it independent? Is it suitable and personal to me and my goals and my needs? Is the access being provided to the best products, right? Institutional quality, high-quality products that GIC buys, other institutions buy. Why can't I get access to that? Ask them that question. And then finally, really read the small print. There's so many small prints that hide a lot of cost embedded into insurance-linked products or unit trust products, and even like trading stocks. People hide cost from us. And so we want to be a transparent platform that gives you exactly what you pay for, the service that you get. And this is a WealthTech conference, but it's a very complicated, weird word. So what does it mean? It just means that what we're trying to do is change the business model of wealth, and we're trying to change the service model through technology so that you can have a better experience and through technology lower the cost of that experience and improve the business model of what wealth is supposed to be, restoring fiduciary duty. As a financial service provider, we're here to serve you, and we're here to serve you without any conflict of interest, always serving the client's best interest. And that's a true fiduciary. I think a lot of financial services have lost that ethos, and we want to restore that. And just to simplify for you, it's like Amazon. They disrupted the retail business. Netflix disrupted the content business. Endowus is here to disrupt and improve and enhance the wealth business. And the most important thing for us is that we are conflict-free, that we're not conflicted, we're not paid by anybody else other than you, the client, transparently, a flat fee based on your assets. We're not paid by the product provider, we're not paid by anybody else. And that allows us to be independent. And we work with many of the names that you saw, Mundi, Dimensional, Franklin Templeton, UBS, etc., are partners in this journey, and they have the exact same values and ethos that we have to serve you in the right way. So we're so excited that we have more than 80 global fund managers, which is a lot, which is more than most fund distribution platforms or banks have. So we give you the choice. But we do more than that. We don't have 4,000 funds on our platform. We actually do the hard work of curating, screening through these funds that are available, and so that we can actually only offer you what we feel is the best fund, the best US equity fund, lowest cost index fund, the best emerging market growth fund, if you so wish. And then from there, those building blocks allow us to build and optimize portfolios that are most suitable for your investments. So that's why the 300 number is important. We want to keep it low. And it's a good thing that it's less, because we do the hard work of selecting those. And the most important number is 0. 0 conflict, 0 leverage, and 0 balance sheet risk. If you think about the blow-ups recently, and these can be in every sector that you know, FTX in the crypto space, and Silicon Valley Bank is a bank, it's one of the biggest banks in California, blew up. And people's deposits just disappeared. And why? Because there was leverage in the system, because there was use of their balance sheet. That's what banks do. They take deposits, they lend it. Deposits are liquid, lending is illiquid. When there's a mismatch and everybody wants their money back, they go belly up. Endowus is built to protect and safeguard your assets no matter what. Even if Endowus disappears, your assets are safe with us, because it's matched $1 for $1, asset-backed, through a secure asset custody. And our operations, our balance sheet, is completely segregated from the client assets. And it's safely custodized through our partners, UOB Kay Hian, our fund partners, and etc., the custodians. And most importantly, I want to focus on why we are so differentiated is the advice piece. The access and cost is stuff that you may not realize as much, but I think the thing that our advocates, Anita and other people, really value is the advice. Handheld, personalized advice. We can leverage technology to make that at scale. We embed advice, we embed content, we embed education into the app so that you can learn, improve. I'm still learning and growing every day, and we can all do that together. And it really is to organize your personal wealth and life. Just like each individual is different, investing is a very personal experience. And so you should have different buckets of money that you invest for different purpose and different time and different goals. And you can do that on the Endowus app. And endowment investing for all of us is the origin of our word, of our name, Endowus. And I think in Singapore in particular, endowment sometimes comes with a very different connotation. But where the name comes from is endowments in the US, like university endowments. Yale Endowment is one of the most important, successful university endowments in the world. This guy called Dave Swenson, you guys should look it up, was a CIO for 30 plus years. And during that period, Yale's endowment, which was one of the smallest universities with $1 billion endowment, grew to over $30 billion. He generated double-digit returns because he focused on the most important thing that drives returns, which is asset allocation. And so we want to bring this kind of institutional professional investing to all of us. And finally, it really is about security, personalization, and most importantly, peace of mind. As I said, we don't want to focus too much on investing. We're not professional investors. And so the Endowus platform is not built to trade more, speculate more, trade faster. That's why we have no exchange-listed products. We don't do single stocks. We don't do crypto. We only focus on the indirect investments through professional investors, and so that you can build the right asset allocation portfolios and strategies to increase the probability of success, improve the probability of outcomes. And we think that as a community, if we can do this together, individuals, partner companies, and Endowus, we can work together, I think we will make meaningful, lasting impact to clients, the industry, the way we work, and society at large. And this is one of the main reasons why Endowus became the first digital advisor for the CPF investing process, end-to-end. We built that over 2 years to really bring that experience and lower the cost and improve outcomes for everybody. And as I said, change takes all of us. It needs a village to create success. And we're here to serve. You'll see many Endowus employees, client advisors, investment professionals. So please engage them. This is your time. So engage them, ask them questions. And we also need help. We're here to serve individuals for whether you're high net worth or retail, doesn't matter. We're here for everybody, for your CPF, for your cash or SRS. But we're also here for family offices and families. We also serve some institutions. Most importantly, we serve a lot of foundations and charities and endowments who fall through the gap. They're not served very well. So we would love to serve this segment of the community. And if you know anybody, please introduce us to us so that we can help them steward their resources in the right way. And we're passionate about education. This is the reason why we hold this conference. And all of the ticket proceeds are going to the Endowus Empower program where we work with charities. But education is so important for us. So please enjoy the time today, ask a lot of questions, learn, and let's try to do this in the right way. Thank you, everybody.
Thank you very much, Sam. You know, it's so interesting for me. I'm a new investor,
Yes.
right?
Yeah.
And my investing journey, I'm 52. This is when my investing journey actually begins. And the reason that it was so easy with Endowus, I would sum it up in one word. I think we need to move out of the way. We need to move over here, otherwise we'll get thrown off stage.
Yeah, run over.
Was that there's so much relief in the whole process. Ooh, maybe we have to also move away from
Feedback,
that speaker.
yeah.
Okay, we're good here now. All right, we got our space. It was relief, actually, and it's so many of the things that you actually said, and it's not because I'm in their campaign, guys, seriously.
Anita's not paid for that.
No, not at all. I just felt a real sense of relief and also understanding and ease. That was the other thing that I didn't feel when I went towards banks, for example. You know, how did that really come about? Why did you guys decide that, okay, this is the direction that we're going to take?
Yeah, I think a lot of us come from industry background. We're financial professionals from institutional background. I don't know if everybody knows, but I do come from institutional investing background at Morgan Stanley for a long time. And really, it's very difficult to find this kind of investment experience, even as a professional. Right? So when I manage client assets, institutional assets for Morgan Stanley, then I get access to really good professional advice, access to great products, and GIC doesn't pay 1% upfront sales charge and 1% management fee. They pay something very low. So we really envisioned a world where we can access those institutional products at the cost so that we can improve outcomes for ourselves. So that's how we began.
Love it. Ease, authenticity, and extremely truthful. And here's the other thing. I ask what I thought were a lot of really stupid questions, but with these guys, there's no stupid questions, which I love. Thank you so much, Sam. I think you're going to be moderating our next panel, right?
I am. I'm going to go down and then bring them up.
Very good. Okay.
Thank you, Anita.
There we go. All right. So you've heard a little bit, and now we're going to get into our panels for today. The first panel of the day is actually where are markets headed, which is what we all want to know, and where should we actually be investing? Our distinguished speakers will be discussing this, and they are Joel Teasdale, Head of Wealth Management Group, Asia ex-Japan and Vice President, Dimensional Fund Advisors, Chuyen Liu, come on up guys, Chief Investment Officer AIA, and Subhash Pillai, Regional Head of Client Investment Solutions, Franklin Templeton. Welcome to our wonderful panel. And of course, if you are already brimming with questions, you know what to do. Head on over to slido.com. The event code is EWC 2023 and fire away. Sam, over to you.
Thank you, Anita. Great. I'm going to change tact and be a moderator now. I've done my speech, so I'm done for the day. Really wonderful to have amazing speakers from some of the most important financial institutions globally. And we're going to go straight in because we're a little bit over time because I rambled on too long. So let's let the lady go first, I think, Chuyen.
Sure.
As a CIO for one of the largest institutional investors, you look at the macro, you look at the markets. And maybe you can kick us off with some of the key themes you're seeing in both the stock market and the bond market, and how should investors look at these core assets, as we call them?
Sure, no problem. Can I have my first slide? Good morning, everyone. I'm Chen Yan from AIA. I'm the CIO, Chief Investment Officer, not Information Officer. Nowadays, there's a CIO for Information Officer as well. So my first slide, let's look at our market so far. So we just experienced low interest rate environment for the past 15 years after GFC. For the next decade or even longer, what we experiencing would be the end of cheap money, which means low interest rate. Now interest rates higher for longer. You can argue when the Fed will cut interest rates and whatnot, but anyways, it's pretty high and could be sticky for a while because inflation is also quite sticky. So 2023, we started as a pretty good year, right? Last year was a lot of pessimism in the market, especially equity market, because people focus on equity a lot. Everything's down 10, 20%. This year, if you look at all the equities across the board, they are all in the positive territory. China will put out a sign. China has a different situation to deal with. Bond market also starting to turn positive, even though the yields are still quite high. Okay, gold still runs, oil still runs, especially recently due to the unrest in Middle East. So 2023 at the very beginning looks like a much better year, but life is not without volatilities and uncertainties. So what we're dealing with right now with higher for longer interest rates, which means that funding will be expensive, liquidity will be scarce, and we also have a bit of headwinds. The soft domestic consumption from China, US-China tension, the unrest in Middle East, all these are adding volatilities to our environment, okay? So fundamentally, it will start to look better, but you still have a lot of headwinds. Interest rates not going to go down anytime soon. Maybe will go down slightly, but it will still be quite high. Equities, you can see so far still in the positive territory. That's global equities, that's US equities, okay? Then you can look at all the other fundamentals. It's still quite on the way to recovery, but the recovery might be challenging going forward. So it's quite a challenging and dynamic market to navigate from here.
Wonderful. Thank you, Chen Yan. Maybe I can turn to Joel, and I was just wondering, maybe the audience is less familiar with dimensional. Who knows dimensional? I've heard of dimensional here. Okay, wow. Put your hand down. Okay. Who's heard of the Booth School of Business at University of Chicago? Put your hands up.
Oof.
Yeah. Okay, a little bit more, different crowd.
That's more than normal, Sam.
Yeah. So David Booth is the founder of Dimensional. He put his name on the University of Chicago School of Business. But Dimensional is one of the largest asset managers in the world and a leader in the systematic kind of evidence-based investing. So maybe you can first of all introduce, Dimensional and how it's so different and unique. And then, what should investors be doing in this market and macro environment? Does it actually affect you in any way? Yeah.
Sam, thank you for the questions, and thanks for the opportunity of being here today with our investors. I think to start with Dimensional, Sam's right. Dimensional is a very large asset manager, which is in 10 countries around the world. We have 14 offices, head offices in the United States, in Texas of all places. And for Asia, head office is here in Singapore. We've had an office here for 10 years and been working with Endowus since before you started taking money at the very start. So very privileged to have that opportunity. So yes, we are a large manager. We manage somewhere between $600 to $700 billion US dollars, depending on what markets are doing. They're always going up and down, as my colleague just enlightened us here from AIA. And we have a very different approach to investing. So we're a privately owned firm. We manage equity and fixed income, real estate investment trusts and commodities, just equity and fixed income for Endowus. And our approach is that, as my colleague just said, there's a lot of uncertainty in markets. And security prices go on a random walk every day up and down based on our expectations around what future earnings are going to be. And so Dimensional's approach is to buy everything we can on the planet. So a typical Endowus portfolio might have 13,000 securities in it from Dimensional, because we want to capture the return of capital markets and get the return that capital markets owe investors. And over the long term for equities, that's been about 10% or so. And so we don't have any more information than the market. We have a lot of very bright people that work on Dimensional. There's 5 Nobel laureates who've been associated with Dimensional and helped build our investment strategies. But we're humble enough to know that there's hundreds of millions of people putting information into prices every single day. And there's a lot of information in that price we can use to build better portfolios. Number 1 is own everything. Number 2 is, as you say, keep costs low, own it very, very cheaply, and then rather than try and forecast whether markets are going to go up or down, just be fully invested in those asset classes, equity or fixed income all the time. And then there's some small things that we can do that we know about information and prices that can give us higher expected returns if we're disciplined and patient and systematic in our approach. And so I have a slide very quickly I'll put up, Sam, and then I'll stop. If I can go to the slide, please. If you think about all the securities you could buy on the planet, there's thousands of them. And so every single one of these balls could represent a security. They all have different expected returns, and we accept the price of all of them, but there is information we can use that tells us which securities have higher returns over the long term. So in a Dimensional portfolio, we buy everything, and we slightly overweight those securities that have higher expected returns. That's all to do with discount rates. The higher the discount rates, the higher the expected returns. And there's 3 main things we focus on in equities that give you those high returns. We can talk about that later. Sam, thanks for the opportunity.
Wonderful. Just like all of us are dressed very differently today, right? All the way from Joel to Subhash at the end. I'm much more casual actually with sneakers and t-shirt, but I put a jacket on for this. But as we dress differently, there is a lot of investment choices out there. So I think it's really important for us to correctly assess the different opportunities and options available to us, and that's why we listen to these experts. So Subhash, I'm going to turn to you now with the topic du jour, inflation, interest rates. Chinyan just shared with us, higher for longer. How concerned are investors in Asia, and what investment approaches are available which help address some of these concerns about inflation, interest rates, and where we're headed going forward?
Thank you, Sam, and thank you, everyone. This is an amazing crowd, so fantastic. Okay, just before we get into the nitty-gritty of inflation, my favorite topic for the last 2 years, just a little bit about me. Subhash Pillay, born in Malaysia, worked in Australia and Singapore. Good to be back home, frankly. I lead investment solutions at Franklin Templeton across Asia Pacific. What does that mean? That means building blended asset portfolios that look to deliver.
Can we get a handheld mic?
We've lost sound.
Yeah, we lost sound.
Wow.
There you go.
You're back.
I'm back. All right. Well, thank you, everyone. Just a quick introduction. Subhash Pillay, lead multi-asset or investment solutions across APAC at Franklin Templeton. At Franklin Templeton, we've been in Asia for a very long time, about 30 years in Singapore alone. So really, really pleased to be supporting and partnering with Endowus here. So topic du jour, topic last couple of years, inflation, how's that impacting on investors and so forth. So firstly, a little bit on inflation. The path that we've seen over the last couple of years has been this explosion in terms of inflation, up to numbers of 8, 9, 10% in different countries, even here in Singapore, getting into the 7s from memory. But over the last year, we've been seeing this deceleration in inflation. So if you look at US inflation, they've got about 20 measures. They all have about a 4% level to them. If you look at Singapore, come back down to 4%. But here's the challenge, the contemporary challenge, the now challenge with inflation, which is that pace of reduction has really slowed over the last quarter. And there are some new challenges around oil prices, energy prices, of course, the horrible scenes in the Middle East adding to that geopolitical woes that we're kind of having to deal with. So with that background, how does that impact investors? Well, it impacts investors in two key ways. First is, obviously, we're investors in markets. Inflation impacts markets. How's that impacting on our investments? But secondly, it also impacts via cash flows. And I think it's often the thing that we actually don't think enough about. All of us here, our living costs have risen by 10, 15% in the last 2 years. Now, how does that impact your ability to save, your ability to contribute to your investment portfolio? And then secondly, many of us have debt. Interest rates have risen, and that servicing aspect is something where you now have these competing demands for your surplus. Do you invest? Do you support reduced debt that you have? So what are investors doing? One of the key things that we're seeing is that I think as inflation has risen and become more of a consideration, investors are looking to get benefits from their portfolio throughout the investment time horizon, rather than having more of a longer term, what's the total return opportunity 5, 10 years away. So that is driving a lot of flows into income style products, where really the benefit that you're getting from investment is happening across the shorter term in terms of higher distributions. So income style products are typically giving you 6, 7%, sometimes higher, and they're also giving you some prospect for capital gains. And that works for investors in this environment because they are able to get that stream of return that can help either with living costs or help with managing your responsibilities if you have borrowings that are supporting your portfolio or your house, for example. So I think that's one major area of change. The other aspect I think that inflation has done is, of course, that's changed the full interest rate environment. Doesn't matter where you live, interest rates are either 300, 400, 500 basis points higher. And that has changed relativities. As Chun-Yen showed, that has resulted in a meaningful repricing in assets. And so there is greater uncertainty around how do I stay diversified. And so I think that is actually also prompting investors to want a more diversified approach and also be a little bit more tactical, because some of the moves that we are seeing are quite unusual in size and magnitude.
Wonderful, Subhash. Going back to Chun-Yen, you mentioned we talked about high for longer, but I just got a few clients yesterday asking me, when is fixed income going to turn around? Right? We've had 2 negative years of returns annualized, 21, 22. If this year we've just turned negative in returns, and it's been very volatile, right? So maybe we'll still end the year positive, but if we have a 3rd year of negative returns for fixed income, it's the first time in history that this has happened. So people are not used to it because it's considered a safe asset, right? So from an asset allocation perspective, what are your thoughts on fixed income, and is it going to come back?
Sure. Thank you for the question. So I tell our agents and clients every single time I'm on stage and sharing how to invest. Think about it. What are we all doing here? We are not here to listen to one stock idea, right? We are here to create our wealth in the long run, and accumulate our wealth for our retirement or for our next generation. There's never a good timing to get into the market. If you look at fixed income right now, negative return or just turn slightly negative isn't a great chance to go into the market, a great entry point. And when you are going into the market, don't think about, I'm going to invest in that bond or that equity. You have to think about asset allocation. You have to put large part of your wealth or your available cash flow for long-term asset allocation. That means allocating to different asset classes, fixed income, equities, or whatnot. Okay, it's never going to pay you back if you just focus on one stock or one bond. That never pays off. So long-term asset allocation is key. And how do you select the managers that can help you to invest? In the world, there's about 61,000 listed companies. For the past, my statistics shows, past 30 years, okay, 61% of the companies are creating negative values for the global wealth, for the global equity market. 38% of the companies are creating positive values just to offset the negative values created by those 60% of the companies. So they net each other off, left with 1.3% of the world's equity markets, listed stocks, 1.3% of the companies in the whole world. That actually creating the $33.5 trillion of the capital market that we enjoy today. What does that mean? You need professional investors to select the stocks for you every single day. That's what they do best. That's what you pay them to do. Don't select the stocks yourself. And select the right managers that can pick the 800 out of the 61,000 companies that are actually creating values for the past 30 years and will be the companies that create the values for the future to come. What does that tell us? You have to invest in, yes, you can invest in passive funds. That can be a part of your investment portfolio because none of us like volatilities. Active managers, and the active managers who can steer through this very uncertain times for you, who can select those 800 companies out of 61,000 companies. So you have to believe in the stewardship, believe in active management, on top of your passive allocation, of course. So that's very important parts. One, invest for the long term, focus on asset allocation, don't select single stocks. I think all of you here are making the right step towards creating long-term wealth. Because all of you here are listening to us on stage, we talk about not one stock, right? We're not here to tell which stock to invest, but tell you it's important to stay invested, stay for the long term, and select the funds that can help you to generate returns in the long run. The funds that will focus on the 800 actually create values for the whole world, not the 61,000, okay? And the last thing, you have to believe in your own investment style. You have to be true to yourself, who you are as an investor. How much risk can you take? That will determine how much equities and fixed income you can go into. So the risk profile, very easy. More conservative ones, 30% equities. Balanced ones, 60%. If you're really aggressive, 90%, right? That's a rough guide of which risk profile you are in, all right? Then you have to understand who you are. That really starts from within who you are, and invest in long term. For long term, stay invested, and select the funds that can help you navigate through the very uncertainty times. Okay?
Thank you, Chenyan. Going back to you, Subhash, you are a multi-asset guy, right? So we're going to talk about the asset allocation that Chenyan highlighted. But I was just looking at the Slido questions, the top voted. Guys, if you don't vote, then you're not going to come up. We don't have time for all the questions, so I'm going to only focus on the top voted questions, but all of them are actually individual questions about different asset classes. So the first one was currency, US dollar. Second highest voted is gold and commodities. Third one is Singapore REITs, very specific. And then the fourth one is China, and the fifth one is interest rates and fixed income. So it's all asset classes, right? And when Chenyan says that asset allocation is important, it's because long-term asset allocation drives more than 90% returns because each asset has a certain characteristic. It goes with it certain risk, which is measured by the volatility of returns, and then how much long-term returns it normally would give you. So if you asset allocate in the right way, then that's what's going to drive the returns over the long term. That's what it means. So Subhash, from a multi-asset perspective, can you answer some of these questions? What are the best ones?
All right. Well, look, let's start with what no one's asked about, which is the largest capital markets in the world, right? So the United States, 60% of equity markets, larger, a larger part of fixed income markets, and then I'm going to come back, right? So if you were to ask us where we see the best risk-adjusted opportunities right now, we actually see it in high-quality fixed income, high-quality US fixed income. So when you see 10-year bond rates at around 5%, when you see investment-grade credit well into the sixes, these are returns where if you buy and hold to maturity, you have appreciable decent levels of return. But typically, if you look at the last 6 US rate hike cycles, typically when the Fed is done, in the next 12 months, you actually see bond yields fall, 10-year bond yields fall, by somewhere between 50 to 150, 200 basis points. So for us, we feel as though the US Fed is closer to that end point, if they haven't already hit it. And so for us, we see high-quality fixed income as, from a risk-adjusted perspective, an attractive place to be, because you can see returns close to double digits if you see bond yields rally, which would be our expectation, especially given the large sell-off. You know, you highlighted we are close to 3 years now of negative returns. If you add up the negative returns in US fixed income, it's close to 25%. That's the largest drawdown. Why? Because frankly, things were priced with retrospect. You know, I think you guys would have all seen charts that kind of go, the amount of bonds that have negative yields, 12 trillion, 13 trillion, 15 trillion, I don't know where it got to. But that chart is right at about 0 now, right? So you've seen that repricing. So that for us drives, that is kind of like, you know, an attractive market. You know, we continue to see attractiveness in the US equity market. Again, you've seen a large drawdown. Yes, you've seen recovery this year, but now you're actually seeing that given away. So we see select opportunities there. When it comes to emerging markets, one of the questions, I told you I'd get to those. Now, keep in mind, emerging markets, less than 10% of the investable equity markets. Now, the challenges you face there are, of course, we're still at a more elevated stage of geopolitics. And also, while there is stimulus ongoing in China, we get to kind of see that really strong stimulus that propels the economy forward. So what we do see in emerging markets is definitely very attractive valuations. It's a sensible place for long-term investment, but I think you need to be patient in your expectations, because there are ongoing risks, there is ongoing adjustment. Coming to currency, sorry, you gave me quite a few. So
you don't have to answer all of them, but
I'm
just
gonna
on currency, US dollar, yeah.
You know, I think the US dollar for us, we would favor as the US Fed looks more and more done in terms of their work, and attention moves much more towards, well, what will be the path down? Then I think you will see some moderation in the US dollar.
Okay. At this point, I'm going to make a confession. I've been investing for almost 30 years, professionally. I'm a professional. I've been working professionally for 30 years, even though I look like this. I have the gift of immaturity, so I'm very immature, so I look younger. But, and, you know, when I was a professional money manager at Morgan Stanley, I used to run tens of billions, and, you know, I did pretty well. I got, you know, to CIO and CEO, so I must have done something right. But when I look at my returns, if I can, like, beat the market 51% of the time, I'd be really happy. It's a very difficult thing to do. And so we talk about asset allocation a lot because that's the high level, the strategic asset allocation that's important. But when we talk to investors, and you guys have all tried it, it's very difficult to beat the market. It's almost more difficult and impossible to also time the market. So that's why I think, you know, a lot of people turn to passive investing, and you know, that's why we've had this passive investing revolution. But there is a place for active. But dimensional kind of sits, it seems like, in between. So yeah. What is that? So just, you know, explain to us, first of all, the advantages and maybe of passive investing, yeah. Index investing, and what do you think dimensional does that enhances the passive investing experience? Yeah,
thanks, Sam. I think just first of all, your points on asset allocation are super important. And one of the great opportunities we have working with Endowus, saying we as investors, is they have strategic asset allocation portfolios that are rebalanced for you on like a daily basis. So whether markets are going up or down, or our opinions on what happened to interest rates or the US dollar or which market's going to outperform, you don't have to worry because your asset allocation is taken care of. The next thing is then how do you get the best return from that asset class? And so dimensional is a mix between traditional passive indexing and traditional active. Like indexing, you are broadly diversified and you're low cost, and the founders of dimensional actually built the world's first index fund back in 1971. So we've been at this for a while, and it's great. The benefits of that are you will capture market-like returns. The disadvantage is that traditional indices structure portfolios towards, they overweight the parts of the market that have the lowest expected returns, which are large cap growth companies because their prices are very high. It's because they're good companies. Dimensional says that's great. You should be low cost, should be diversified, try and capture the return of markets. But if you look to what actually drives returns of security prices, it's discount rates. Companies that have more risk associated with them, more subjectivity around their future cash flows, investors will apply a higher discount rate to. The higher that discount rate, the higher the expected return. That's what the investor's return is. It's the discount rate of security you purchase. So dimensional.
For those that are less familiar, can you explain a little bit about the concept of discount
Sure.
rates?
It's the cost. It's the cost of capital of a company trying to get your money. You can lend money to a company in form of a bond, or you can buy shares in a company. The riskier they are, the lower the price. Okay. So, what does Dimensional do? Dimensional says, okay, let's capture the return of markets, and let's look at the data going back 100 years, and let's look at the world's best theory around how securities are priced, trying to marry the two to systematically try and get the return of the market or better. So if we go to the slide, please, folks. I talked about all companies have different expected returns. Some have higher expected returns. Which ones are they? They're related to discount rates. And we'll go to the next slide, and here's the last sort of 100 years. Oh, sorry, go back, please. Okay, so what Dimensional tries to do is to systematically buy lower cost companies that are highly profitable every single day. We remain fully invested. And so 3 columns of data here. The first on the left-hand side is the US stock market. This is going back almost 100 years. And there's 3 elements, 3 dimensions of expected returns in equities that have given you higher returns. First, to do with cost, or relative cost. Small companies, the small companies, have given you higher returns than large companies. For about 100 years here, you had about almost 2% per year, higher return from small companies. Who would have thought that? Second is the relative price. This is the multiple at which they trade in the market. Companies that trade at a small multiple to their book value are less attractive, they look more risky, they've given you higher returns. Over 3% per year for almost 100 years. And then on top of that, more profitable companies, based on their profitability today, saying nothing about what it's going to be in the future, have given you higher returns. So if every day you systematically just overweight smaller, lower relative price, higher companies, or in Singapore parlance, cheap and good la, that's what we're trying to do. I've been in Singapore for 8 years now, right? That's what we're doing, really, and owning thousands. I would respectfully disagree with some of my colleagues that you need to find the best managers and best stocks. You don't. Buy everything, buy the ones that are lower relative price and higher return. And that data extends to the rest of the developed world, which you've got over 70 years worth of data, same pattern. Small, low relative price, high profitability companies have outperformed, and the same in emerging markets. Okay? There's over 45 countries represented here. Whether markets are efficient or they're not, it doesn't matter. These systematic differences occur, and that's what Dimensional focuses on every single day in equities. In fixed income, it's the same. We're broadly diversified. We focus on the dimensions of return, which is around having a variable approach to the duration of your portfolio and the credit quality of your portfolio based on whether yield curves are upwardly sloped or downwardly sloped and credit risks are wide or narrow. So I don't want to chew up too much time, Sam, but that's the point I wanted to make. You don't have to forecast. Own everything, cheap and good la.
Thank you. I think we're going to turn to the audience question, and the top voted one is not a surprise, is China. Can I direct it to Chen Yan? Maybe talk about your thoughts about China and maybe... Yeah, just thoughts about China. It's such a complicated topic, guys.
Of
you can
course.
talk about anything you want about China.
Sure, no problem. We have a love and hate relationship with China, right? I mean, it's the world's second largest economy. It carries a lot of weight in many industries. And our clients, customers, all love China for a very good reason. So where's China now? I think there are a lot of hope for China at the beginning of the year. China did perform after they reopened. It was up very nicely. But you have to realize that China is such a huge economy. For it to recover sharply like a V shape is nearly impossible because they have fundamentals they need to fix. And the government is trying to do that. Actually, the Beijing government is doing a lot of right things. They're trying to deleverage not just the government's balance sheet, which is humongous, but also individuals' balance sheet, because they are trying to come down on the property market, right? So property rise by at least 3 to 5 times, depending on which city you're looking at. In the past 10 years, that's how a lot of people become wealthier. Is that the right level? Might not be. So now they're trying to force a more normalized property price across China. That hits everybody's balance sheet, right? It's the largest part of the GDP. So you can't expect a country whereby the whole country is experiencing that kind of revaluation, normalization of the balance sheet, coming down the property prices that will, their balance sheet value will drop right away, right? And that touches every single family in China. We can't expect they will just recover like that tomorrow. It's impossible. So they're feeling the pain, but it's a great way to set the economy back to more healthier status. This is a pain that they have to go through. But is China uninvestable? Of course not. It's such a good place for a lot of very innovative companies. So when everybody, especially more Western school of thought that they're not going back to China or they are pulling out of China, it's a great timing to go into it. That's why you see a lot of true investors, institutional investors, professional investors, they start to select really good companies, good quality companies with strong cash flow, strong balance sheet to invest. And that they might benefit from this years down the road. But you have to be patient with China.
It's going to take time. Thank you, Chen Yan. I lied, guys. That was not the top voted question. The top voted question was actually, in fact, is Endowus leveraging on Gen AI for advice? But I left that to the end because I can answer it. I think the question comes because a lot of people use the term robo-advisor. And I've written an article about this, that it's actually a misnomer. There is no robot or robo that's going to perfectly predict the market and therefore beat the market every time. If somebody developed that, there'll be a billionaire or a trillionaire richer than Elon Musk, and they shouldn't share it with anybody else because they can corner the market and make all the money. It doesn't exist. And the second thing is robo-advisors, the ones that we know, do not really focus on advice, which is what I was trying to tell you, right? They're trying to develop a product with an algorithm that's going to try to beat the market, and that's the wrong approach. And we talked about a lot of the right ways of investing. And so Endowus does not have a robot that's going to solve all your problems. Gen AI and OpenAI is not, ChatGPT is not going to solve all your investing problems. There's a reason why they don't allow you to ask about financial stuff, because they can't. But there's a lot of things that it does, which is there's a lot of things that makes you efficient, allows you to be more efficient, allows you to really improve your experience as well. So that's where we'll be focusing on. So yesterday we had a presentation on AI, how it's applied at Endowus through the chatbot, through content aggregation and filtering, finding things that you were looking for on the Endowus platform much more efficiently. And help us as a business to be more efficient as well. So please check that out. You can actually go to the YouTube, watch it, and also scan the code so you can test out the new Gen AI chatbot that we've developed. So with that, I'm going to wrap up. And thank you so much, Joel, Chen Yan, Subhash, for your deep insights and for being here with us today. Thank you.
Thanks, Sam.
Thank you. Thanks very much. Thank you, Sam. Thank you, our wonderful panel, for opening today. Lots of big takeaways for the morning. I'm just going to share with you a few of my own takeaways because I'm learning along with all of you. Diversify and stay invested. Don't overlook small companies. Observe how a country is actually helping itself. Be true to yourself and your investment style, which is, I think, something we sometimes forget. Work with the strategist or don't work with the strategist, that's fine. And the most important one is talk to yourself the way Sam talks to himself. Thank you very much to our panel for starting our day off. And of course, Endowus is not a robot. All right. Please join me in welcoming our next moderator, who is So Sin Ting, Chief Client Officer at Endowus, and our new panel of speakers for a discussion on financial planning basics from graduation to retirement. I'm just going to move here so that you can see all of our speakers come on stage. And they are Chojia Rhee, content creator and Endowus client, and I think you've seen her on the ads as well, together with me. This is the first time that we've actually met each other as well, right? Wonderful to have you here. Joy Lim, Managing Director, Market Team Head, UBS Global Wealth Management. Christopher Tan, Co-founder and CEO, Provident, and Yap Ming Feng, Head of Seedly. Sin Ting, over to you. Thank you. Is your microphone working?
I think it is.
Yes, okay.
We're good. Good morning, everyone. Thank you for joining us today on this panel on financial planning through different life stages. My name is Sin Ting. I'm the Chief Client Officer here in Endowus, where I manage a team of client advisors across Hong Kong and Singapore. So in Singapore, money is the #1 source of stress. Is this better? Okay. Yes, money's #1 source of stress here, and it really underscores the importance of financial planning, setting your goals, creating a plan on getting from where you are today to where you want to be. And financial planning is not just about investing, although obviously investing is a very, very important pillar of it. It's really about setting your goals, creating that plan, and as you go through life, that could change as well. And so without further ado, I'm going to pass it to my fellow panel speakers here today to give a very quick introduction of themselves, as well as to share with the audience, at what age did you start investing or financial planning, and what prompted you to get started? We'll start with Chow on my left.
Hi. Can you hear me? Does it work?
Okay, we'll pass you the mic.
Hi, good morning. My name is Chow, and I am a content creator and a host. TLDR on that is that I'm a freelancer, and I think I started financial planning probably around, okay, I can't lie, it's like this year. But I did think that I was investing sometime in uni, but I think what I learned this year is that wasn't really strategy, and there wasn't real planning. It was just kind of like a little bit just going with the flow, following what people were saying. Yeah, so that's my journey.
Good morning, all. My name is Joy. I'm a marketing head with UBS. I've been with UBS for 19 years. I started off as a client advisor. Now, to the questions that Sin Ting asked about when do you actually start investing, for me, I actually start very late, end of 30 years old. But they say that it's better to start late than never. And you know that when you start investing and you get that compound interest, Albert Einstein said it's the 8 wonders of the world, right? What prompted me is also because I moved to the front line. I think about managing clients' money, and why don't I start with myself first? So for me, the big milestone is getting that financial confidence. Though I have kids, I do all the budgeting, I do the school fees, I do the bus transport. But when it comes to investment decision, most women defer to their spouse to do it. So at that age, I thought, why don't I learn the rope and manage clients' money, as well as managing my own money and eat my own cookies? Over to you, Chris.
I'm going to try and speak through the mic. Can you all hear me? Okay, great. Good morning, everybody. Thank you for being here, and just want to thank Endowus for having me here. My name is Chris, and I'm from Provident. I started speculating at the age of early 20s. I say speculating because that was the 90s, and those of us who are my age, you remember the period in 1990s. It was the period of the IPOs. right? So all you need to do is, if there's an IPO going on, just go to the ATM machine, buy as many lots as you can, hope that you can get it, and then once it's listed on the market, sell it, take the money, go for a good meal, and then wait for the next one. Nobody reads prospectus, just buy it, you should never lose money, so they say. So that was the early 90s when I was in my early 20s.
Hello everyone, I hope you all can hear me. So I'm happy to be here. I'm actually the head of Sidley, so I look after Singapore's largest personal finance community. And every month, about 700,000 to 900,000 Singaporeans actually use our platform to make smarter personal finance decisions. That being said, when we talk about when did I start investing, I think it was during when I was in uni. So funny story, my mom gave me $2,000. You will be able to reap some profits from it. She never see that money ever again after that. Yeah, so that's my story.
So open about sharing your journey. I think a lot of us here start out by really speculating, but as the previous panel shared, markets can be extremely humbling. And it really takes, and it's never too late to get started in your financial planning and investment journey. So my first question here is for Chow. Chow, in some of the, your videos with Endowus and in our conversations, you mentioned that you were quite an obsessive saver, as you put it, when you were younger. And you really only got more serious about investing, more recently, as you mentioned, when you become an Endowus client as well. And can you walk us through that process of, saving more and then wanting to invest now? Sorry. Yeah.
I'm not sure if you've seen the videos. I was told that it was played on repeat, but I was a little bit like, oh man, I can't show my face. Because in the video, it really starts off with this hook, which I have to say, props to the marketing team, they did so well with the video. It really started off with me going, I had 48 cents in my CPF account. And I wasn't kidding. I really did only have 40-something cents in my CPF because I had a little bit of a, I'll call it a hiccup with HDB, and I had to forfeit my HDB flat, and that left my CPF just drained completely. And I have to say that it was definitely a trigger in pushing me to plan my finances better. I think it tossed me in the deep end, and it was a bit of like a personal crisis that got me there. But prior to that, I had always been, you're right, very thrifty, very, very obsessed over saving money, because I think I grew up just feeling like I needed to hoard my money. I think the only idea that I had to gain wealth was to save. But I didn't know that I could get my money, I could kind of let my money work for me also. And what changed my mindset was growing up, learning more about life, like losing your house, and also just changing of life stages, so planning ahead. And I think right now I'm in a space where I am planning forward. So I'm thinking about things like, what about my future? Like, how do I go about affording to buy my own place? How do I plan my retirement? And when I started getting these questions, it made me think about how I can better use my money and how can I, start investing. So when I did start my journey with Endowus, my Endowus financial advisor talked me through my objectives in life. Pretty much like it's kind of odd to ask like a 20-something-year-old what you want in your life, because honestly the question would be like, I don't know lah. Like that's just how it's gonna be. I like legit don't know what I want to do, but I roughly have an idea of, I think it would be nice to have home ownership in Singapore. I think it would be cool if I could retire early, but I don't know if that's even possible. I think it's all about setting these goals and then trying to build the steps and working towards them. So what Endowus has helped me done, and my financial advisor, who unfortunately isn't here because she's ill, but I really was looking forward to seeing her, but it's okay. So what they've helped me do is break down, I think baby also wanted to see her. It's okay. So what Endowus has helped me do is to break down the steps to help me reach these goals. And I guess these goals were kind of new, like in this stage of my life. So that's where I got there. And how my mindset shifted from just purely hoarding money and saving to investing was when I understood that saving will not be able to beat inflation, and well, eventually my savings is just gonna, well, what's the term for it? Not depreciate, but like
Eroded.
yeah, that's the word. So it'll erode over time, and it just will be a bit futile. Like all my effort would be a bit futile, and it'll go to waste. And I did think that it would be better to just let. They always tell me this, but I just can't get the words out. They always tell me, let the interest compound over time. And I guess time's kind of what I have now. So I'm using that to my advantage.
Thank you, Chao. Yeah, I'm sure taking that first step is always the scariest. And it's a good segue to Joy for our next question. You know, a lot of people struggle with thinking about their immediate financial needs and their longer term goals like retirement. Retirement can seem a faraway concept for many people in this room today. So, you know, how do we strike the right balance between thinking about our short term goals and yet our long term financial planning through different life stages?
That's a good question, and I think the audience here probably think about it. That's why you're here, right? Having that strategic asset allocation, which the panel in the first panel talked a lot about it in UBS, and as I work through the client's portfolio, that strategic asset allocation is important. It drives 80% of that portfolio performances. So first thing first, you need to get a client advisor, get someone who can help you through this financial journey and walk through with you in different stages of life, right? I mean, that's first thing first, you need to do that, right? Second thing that is easier to do for me is in 2019, UBS actually came out with this report. We call it 3L. That means you bucket your investment into the 3L, which is liquidity, longevity, and legacy. So the first bucket, liquidity, is for investment that could have an investment time frame of 2 to 5 years. Anytime you need it in terms of emergency, that liquidity buckets will give you that liquidity. Then the second bucket is the longevity bucket. That means that money that you set aside for retirement, that money potentially that could grow at 6 to 8% per annum. And using that concept of compounding interest, simple math that we learned in school, rule of 72, if that S&P 500 historical return at 10% per year, and based on rule 72 divided by that rate of return equals to about 7 years, that's the answer, your returns will compound. So if I put in 100,000 in that S&P 500 based on Rule 72, in 7 years it will be compounded to 200,000. In the 14 years, it compounded to 400,000. So what I'm trying to drive at is that in that longevity bucket, I want to maintain my lifestyle. I still want to go on a holiday. If I'm going on holiday once a year, I still want to continue doing that. If I'm having a helper now when I retire, I still want to continue to have a helper to help me trim the plants or to, that lifestyle changes cannot be happening when I retire. I should enjoy my lifestyle, right? So that's the longevity bucket. Now, the legacy bucket is investment that you probably won't need in your lifetime and you would like to pass it on to the next generation. So it can be like what Charles said, a home that you want to pass it on to the next generation. It could be easily our friend from Providence, Christopher. It can be an insurance policy that you never needed in your lifestyle, in your lifetime, and you pass it on to the next generation. It can be the alternatives, the private equities, the hedge funds, which my colleague Melanie will speak about it later, that you probably lock it up for a longer time, 10 years or more, but you potentially have the alpha in investment return, and you pass it on to a lifetime. So to Cynthia's question is, strategy asset allocation, one should have in a portfolio because that's what we do best. That's how we don't time the market. We potentially compound interest. But on our own Excel spreadsheet, when you look at your own net worth, you probably just bucket it into 3 buckets: liquidity, longevity, and legacy. I hope I make some sense. Thank you.
Yeah. No, thank you, Joy. I mean, you work with really ultra-high net worth clients and family offices on a daily basis, but I think the framework that you shared with us is very applicable to everybody in the room today, too. And maybe this is a good segue to Christopher, and when Joy mentioned insurance as part of legacy planning, and insurance is a big part of what you do at Provident for your clients. And for those that don't know, I mean, Provident was really one of the pioneers in Singapore for conflict-free advice. When you think about protection, do you think Singaporeans are paying, too much or too little for insurance coverage? And, what are the differences between whole life and term? And what do you think is right for individuals at different life stages?
Okay, yeah, thanks very much. I think I'll take the first question first, whether Singaporeans are paying too much for insurance. I'll say generally yes, I think we are paying too much, but that does not mean that we are adequately protected. Because we pay a lot for premiums, but because we buy a lot of wrong insurance, and therefore we may not be sufficiently covered. But I think over the years, over the last 20 years, I mean, that has improved a lot, especially among the younger generation, and I think they are beginning to understand what insurance is for. I do see a lot of improvement in that area. Now, to answer the rest of the questions, maybe I'll approach it this way. First, we need to understand that the primary purpose of insurance is for protection. That is why it is called insurance, right? It's for protection. Because if you want to save and invest, there are better instruments out there to save and invest. Insurance is a very lousy instrument for you to save and invest. It's a very expensive way to save and invest. The returns are not interesting at all. Now, I'm not saying that you cannot buy insurance to save and invest. There are people who should buy insurance to save, but for most of us, that's not a good insurance, or that's not a good instrument, right? So the primary purpose of insurance is for protection. So then how can we insure ourselves in the smartest way? 3 things that we need to know before we buy insurance. First, we've got to ask ourselves how long we need the insurance. Second, how much. Third, we then buy the type of insurance that's suitable for us. So how long, how much, what type? How long do you need insurance protection? Well, if you're buying insurance for the purpose of replacing your income loss in the event of death, disability, or a medical crisis, you only need it temporarily. This is because there will come a point in your time or in your life whereby you will no longer need an income replacement. For example, you have achieved financial independence, you are retired, or you got no more dependents, you don't need to replace your income anymore. So if you're buying insurance for the purpose of replacing your income loss in the event of death, disability, or a medical condition, you only need it temporarily. Then what type? Well, if you are only covering your risk for a temporary period of time, term is probably the most suitable, right? Because it's temporary cover. And if you worked out how much insurance you need, you realize that actually, if you are young, the amount of coverage you need is actually a lot, $1 million maybe. If you try and buy that with whole life, you will never be able to cover it adequately unless you're prepared to pay $20,000, $30,000 a year. So term is the cheapest way to cover yourself adequately. I'm sure many of us have heard of buy term, invest the rest and all that. Perhaps I should say that buying term is not for the purpose of investing the rest. Buying term is because it is the most affordable way to cover yourself adequately. Right? So does that mean that there is no use for whole life? No. Let's go back to how long do you need. If you are buying insurance to pay for medical expenses, such as hospitalization expenses, or for example, a critical illness, then you will need this kind of insurance for as long as you live. Right? Because whether you are 30 years old, 50 years old, 70 years old, if you are sick, you want to have insurance to fall back to pay your medical expenses. How much do you need then? Well, if you are buying hospitalization insurance, for those of us who are Singaporeans, PR, even foreigners, right, you can buy integrated shield plan. So you buy the plan that is suitable for the ward that you want to stay. So if you want to have an option to stay in the private hospital, buy a plan that allows you to do that. Right? How about covering for alternative medicine? Because sometimes hospital plans don't pay for alternative medicine, for example, TCM. How much do you need? I'll say maybe 100,000, 200,000 is sufficient. So how long? Whole life. How much? Buy the hospital plan that's suitable for the ward. And if for critical illness, maybe 100,000, 200,000, then what type? Then you do need to buy a whole life, right? Because you want to cover it permanently for life, right? So that's how you assess what type of insurance you need. And at different age group, you decide what kind of insurance actually do you need. If you are very young, your need for insurance is actually very, very low because you have very little liabilities. If you die, nobody is going to miss you. I mean, nobody is going to miss you financially. Okay? I hope some people miss you emotionally. Okay? But for the younger ones, if you passed away, very few people is going to miss you financially. So your need for insurance is actually very low. Just have a good hospitalization insurance and maybe a critical illness plan. I think that's sufficient. But as you move into life and you get married, you have children, you have mortgages, you have liabilities, then you really need to buy insurance to replace your income loss in the event of death, disability, medical expenses, and all that, right? And then as you age and you go into retirement, again, your need for insurance drop. Because when you are retired, you are financially independent, you are no longer earning an income. I mean, there's no income to replace in the event of death, disability, or medical condition, right? So for those of us who are retired, what is most important is to have a very good medical plan, right? Because in all likelihood, that's the age. I'm not saying that we don't fall sick when we are young, but as we age, chances of falling sick becomes higher. We need to have a very good medical plan to give us that option to seek out the best possible medical care. Okay? Yeah.
Thank you, Christopher. For Mingfeng, you engage a lot with the Seedly community. What are some of the top questions that you see when it comes to financial planning and investing? And do these concerns typically involve when people are moving through different life stages, like having their first child or buying their first house?
Okay, so I think for more context right now on the Seedly platform, we have about close to 70 to 80,000 discussions. In fact, so I need to do my homework, right, since I'm here. So I did a quick check just now. The latest discussion about Endowus is 8 days ago. And this month there was numerous discussion around it. So it's pretty interesting. I think number one, I wouldn't say thanks to COVID, but I think when the work from home situation happened, the lockdown happened, it accelerated the habit of going online to find out more information and discuss accordingly your various situations in terms of personal finance. So that's one. Next, over the years, we have also noticed that, in fact, the audience, people today, they are more than happy to discuss their financials online. I think if you look at, maybe for me, my parents' generation, that was something that they will not be comfortable with, right? I mean, if you go to them and say, Papa, how much you have? He would think, hey, you're trying to war, is it? You're trying to curse me, is it? So I think the whole entire stigma of opening up to discuss your finances have changed. We are starting to see very in-depth questions across various multiple verticals. So I'm going to share a few things that have happened over the year, a few trends that we spotted. Number one, I think in the year 2019 and 2020, definitely there's a lot of hype around cryptocurrency. We see a huge influx of discussion around cryptocurrency. Just this year alone, we have 49,000 discussions on general investing. And a lot is no longer about just stocks. They are talking about platforms to use, which is platforms like Endowus is being discussed quite a lot on the community. They're talking about specific portfolio they have with some of these platforms. They're talking about fees. So I think generally, because of the access to some of these financial products, people are more well-versed today financially in terms of tools that's available to them and what they can do. And from there, they also know that personal finance is very personal, right? So what works for me may not work for certain people. So I can read a blog article or I can read an article on various personal finance-related products that I think might be suitable for me, but it's always important that I open up the conversation to someone who's in a similar situation to see whether that is something for me or not. So these are trends that we are starting to spot, and I think it will continue. And it's actually a good sign that everyone is more and more financially literate.
I mean, knowledge really is power, and it's quite amazing how some of the platforms like Seedly have grown the last few years. And it really shows how much interest people have in financial literacy and gaining more knowledge in this space. We're getting actually a lot of questions coming in on Slido, so I'm going to jump straight into them. And I'm looking at the ones that are most upvoted first. Maybe for Christopher to start, how often should we revisit our financial plans? After we've created a plan, do we go back to it every year, every month? What do you think is the right kind of cadence?
Yeah, I suppose if you are investing for the long term and you are planning for yourself for the long term, I would say, at least that's what we do with the clients. I think you should review your progress on a yearly basis, right? If you look at your plan that you have put in place at the start of the year, or when you, I mean, it may not have to be the start of the year, but when you, after you put in place a plan, 12 months later, I think it's a good time to look at whether you're keeping you're keeping with your budget, how your investment is performing, whether you are close to what you expect it to be. I don't think you need to review your insurance every year. I think a good time to review your insurance is when you have significant changes in your life. For example, you have a significant pay jump, birth of a newborn, and things like that. Right? I don't think there's a need to review plans every year. A lot of times, if you get a call that your advisor wants to review your plans, you usually know what that means. That usually means that you need to buy another product, right? But I don't think you need to do that so frequently, especially where insurance is concerned. Yeah.
Thank you. We have a bit of a personal question for Chow, so I hope this is okay to ask you. So what does your portfolio comprise of?
I like this question because I was pretty excited to put them together. It was the first time I had laid out my finances with a professional, and she had insights into what I wanted. From there, she could advise me about what best to choose. So I have two portfolios. The first one is for buying a house or a home. I think a home, right? Home is like where there's the feeling and all that. Okay, by buying a home. And then the second portfolio is for retirement. So the buying a home one is a little bit shorter term. So we're looking at a time horizon of about 2 years, 1 to 2 years. And for that, it's less risky. So she helped me to adjust and make sure that it's not into, like riskier ones would be stocks. So that's not a equity heavy portfolio. But for retirement, it is mostly in equities. And that's because I've got a much longer time horizon. So that's the main two portfolios I have. I feel like they are quite different from each other, just because the main difference being the time horizon that I have to work with.
Thank you. Thank you for sharing your very personal
All good.
portfolios. Moving on to Joy. In terms of asset allocation, Endowus and other advisors, they usually talk mainly about, equities and fixed income. What are your views on adding things like gold and commodities to one's core portfolio? Do you think there is a place for it?
Yes and no. So in terms of strategic asset allocations, we could put in the bonds, we could put in the equities. Lately now, when I've worked with individuals as well as family office, as well as even charities, associations and schools, they're increasingly looking at endowment style of investing. That means as much as 20% of the portfolio up to 40% of the portfolio goes into the alternative space. These are your hedge funds, these are your private equities. And this endowment style portfolio concept comes from the Yale Endowment University, the Princeton Endowment University. So what they do is they have a lot of funds in the school and they put it into all these alternatives as much as 40%, and they publish the returns on a yearly basis, and we're looking at about 12 to 14% per annum kind of return, which is not bad, right? So a lot of us investors are starting to think that maybe potentially I can do 20% or 40% on portfolio into that, and when you lose less, the chances of you making up in a market that is down is also easier, right? So gold and commodities. Yes, it's part of that asset allocation, but be mindful, I cannot buy barrels and barrels of oil. I can buy gold, but it's also an opportunity cost in that sense because it doesn't pay me dividends, it doesn't pay me coupon like a bonds or a DBS shares that pays me dividend as well. So to your question, if in terms of wars time, like Russia and Ukraine, Israel, Hamas, people talk about gold, people talk about oil, and see where it goes. It is more like a small allocation in a portfolio, but it doesn't need to be a meaningful size if I can summarize that.
Thank you, Joy. For Ming Feng, so we have someone who asked, I'm age 29 now and thinking about how to FIRE by 39, which I know is a very hot topic on Seedly, right? I've been working for 3 years. I think about my savings, my spending rate, my investments, growing, improving myself to progress in career, as well as pursuing side hustles. What else should I be thinking about?
Okay. Yeah, so that's the kind of question we receive every day. Very specific age and objective. Some even tell us the amount of savings they have. So I think I had this conversation actually with the work salary man a while back. We met at a panel, and I think first and foremost, FIRE is a concept that I think most of us want to have, but you also need to ask yourself, what does FIRE mean to you? Is that something that you are actually looking forward to? Give you an example, if I am fired by tomorrow, right, I will be lost. I will not know what to do. Is that the lifestyle that you want? That's one. Number two is when you understand what does FIRE means to you, then you can work backwards to calculate the kind of expense and the kind of savings, the amount that you need. So I think a few years ago we did a bit of a study and research, and we noticed that actually that was about 3 to 4 years ago. You need about $1,200 per month to retire, to just spend on your basic expenses. Means no holiday, nothing, just basic, $1,200 per month. Fast forward today, I believe that amount could be close to 2,000. I haven't do the math, but if you think of it this way, it means that if you are trying to retire in 10 years' time, the amount of savings you require is going to be way more. You need to take into account this potential increase in the cost of living. And then you need to take into account what kind of lifestyle you want. If you want to go on holiday every year, how much you need to spend. So all these are actually factors that you should try. So it's a bit like sorting out your portfolio. Just that now you have like these baskets of savings for various items that you need when you retire. Last but not least, on top of side hustle and of course protecting your downside with insurance, how are you going to constantly generate income when you decides not to work tomorrow and retire, right? So that portfolio that you're building, what's the risk and what's the returns that you potentially can get? Is it predictable and stuff like that?
Can I just chime in a bit on FIRE?
Yes.
So yesterday I was doing a talk for a charity on FIRE. I'm not sure how many, whether everyone here knows what's FIRE. Generally, this term is more familiar with the younger people. So I asked this whole group of people, and then one side was the younger people, and they all put up their hands and say, yeah, I know what's FIRE. And the other side said, what's FIRE? Right? So FIRE stands for Financial Independence, Retire Early. A person who believes in this whole philosophy of FIRE, well, they earn a good income, but they'll scrimp and save, as much as they can. So they in a way, delay gratification. They spend very little now. They save as much as they can. They invest aggressively, hoping that they will be able to achieve financial independence at a very young age, like 35, 40 years old. Now, this concept, well, it sounds really good, but I just wanted to share a word of caution, because unfortunately, all of us, we don't have a contract with God. Life is not like that, right? We don't, work very hard or study very hard and then work very hard and then we retire and we live happily ever after. Life is not linear. Life is uncertain. We can die today. We can die in 1 month's time, right? So if we delay everything to the future, there might not be a future, right? So it's actually very important in pursuing FIRE to think about things that actually I do need to spend on today, even though I can't FIRE at the age of 29, 30, 35, because there are things that cannot be delayed into the future. For example, going for a good holidays with your family to build memories with your young children. By the time my kids are 25 and 21 years old, it's very difficult to get them to go on a holiday today. If I want to go to Taiwan, they say only old people go there. We don't go to Taiwan. They don't want to go with me anymore. They want to go with their friends, right? And I want to build memories when they are still young. Well, when our parents are around, we want to really, really lavish on them. Both my parents passed away the last 2 years. Even if I want to do that for them today, I can't do that for them today anymore. There are purposeful things that you may want to do today, like giving. Right? Yesterday, the charity was on helping the people break the poverty cycle. I can't wait 10 years later to help these people. So in FIRE, while the idea is good, please do not scream and save too much until you deny yourself a life today, because life really doesn't start in the future, it starts now. Right? So I just wanted to talk a bit about FIRE in that regard. Yeah.
Just to chime in a bit, so these are the little topics that we talk to our clients about. What matters to you now and who is important to you? So these are live questions, but I guess once we have the answer, we know how to properly plan.
Yeah, no, thank you. And I really like the point that you made, Chris. I mean, I have a 1-year-old daughter, and I have to always remind myself that, it goes by so quickly. It really, really does, and you don't want to, and once it goes by, it's very hard to turn back time. Yeah. We have quite a few questions on insurance, Chris, so I'm going to combine them into one for you. So firstly, how do you define spending too much on insurance? And do you think investment companies are making term insurance more expensive now in response to people talking a lot more about buy term and invest the rest?
Yeah. So because insurance is for protection, it is an expense. Buy as much as you need, but spend as little as you can. So I cannot say I don't like rule of thumb for insurance that you should, spend a certain percentage of your salary on insurance. Because if you don't need it today, even if you buy $1,000 premium insurance every year, you are spending too much. Right? So there's no definition. If you don't need it, you buy it, you are spending too much. Right? Now, term insurance is actually getting cheaper. Right? It's not getting more expensive. It's become very competitive over the last 10 years. Companies like Singlife, in the past Aviva, they were the ones maybe 10 years ago that gave a huge discount on term insurance. So I'll just say that no, it's really not becoming more expensive. Actually, it's becoming cheaper. And for those of us who have served national service, one of the cheapest insurance you can buy, as you all know, is the MHA MINDEF Group Term Plan. If you don't have it, please go and buy it. It's very cheap. Ladies, if you want to buy it, marry someone who has served NS. Promoting NS.
I think that's all the time we have today. Thank you so much to our panel speakers for being so open and sharing your expertise and thoughts with us. Thank you.
Thank you.
Thank you, everyone.
Thank you.
Thank you, guys. What a rich discussion. I took so many notes. You guys take notes? I was writing, and I almost forgot I need to come back up on stage to say hi to you guys again. Was that informative for all of you? Okay, we have so much more going on. Don't move anywhere, don't go anywhere. A few takeaways that I actually wrote down were real stories, I think, have an impact that is very immediate. It allows us to think deeper and I think learn very, very quickly. Client advisors should be able to walk you through all stages of life, not just one stage or 2 stages of life. Paying more doesn't mean you're always getting more. Open knowledge is power, and we are really in an open knowledge time of the world's trajectory. FIRE, that was the first time I heard that expression. Who else, that was the first time they heard FIRE? Come on, be honest. Okay, good, great. Because I always thought I wanted to be financially independent and never retire. But one thing I want to say that, the panel discussed that, maybe it's hustling too much and so forth. I actually think FIRE points to wanting a different kind of life trajectory. That's what it really is. And also, I think it's useful to remember to think about your life more holistically, and that even though you might want FIRE, life is not linear, which is, I think, what was brought up actually by the panel as well. You guys had fun? Good. All right. Thank you very much once again to our panelists. We're going to pause for a tea break, but before we go, don't go anywhere, guys. We are actually going to run our first lucky draw, and the prizes are so fantastic, so please stick around, okay? All the people who rushed outside to get a coffee, if they win, too bad. So evil. The first prize that we have today is a 2-day, 1-night stay in this beautiful hotel. It is actually worth $640. I love this hotel. And we're going to spin the wheel and find out who actually wins this prize. Go for it, guys. Spin the wheel. Look at us all digital. Sok Hoon Chua, that's your number. Are you here in the room? Are you here in the room? Yes! Come on up and receive your prize. And I would like to invite our Chief Client Officer, Sinting, to come out here and hand out the prize, Sinting. Let's get you guys in the center and pose for the photo as well. Yes. Okay, do you want me to hold your handbag, Soko? Because you're gonna want this photo. All right. Congratulations. Thank you very much. Enjoy your stay. Who are you gonna bring on this stay? She's not telling me. She's having it all to herself. Thank you very much. And thank you very much, Sinting, for helping me as well. Guys, we have a 30-minute, is it still 30 minutes? 20 minutes. Tea break. Refreshments await you outside. Don't forget the back of your pass has a few little stamps. That's basically for you to interact with all of the people that we are working with outside. And it also gets you an extra special cup of specially brewed coffee or tea, please. Don't forget to redeem that. Thank you, guys. See you later. 20 minutes. Be back in the room. Whoever is still out in the lobby, please come in and join us. We have a few seats in the front. If you're new, welcome to this wonderful morning of great insight. Just going to let everybody get settled. Okay, wonderful. Up next, okay, everybody got a coffee and a tea? Feeling all caffeinated and ready to go? Good. Fabulous. So did I. Up next, I would like to invite on stage Gaëtan Delculé. He's the global head of ETF, indexing, and smart beta sales, and the deputy global head of distribution and wealth sales at Amundi. And he's going to give a short presentation discussing future planning for investors, thinking long term, one of our favorite subjects. Gaëtan, it's all yours.
Good morning, everyone. Thank you for having me today. I am Gaëtan Delculé, the Global Head of Sales for ETF and Indexing at Amundi. Amundi is a French-based company, and it's actually one of the largest asset managers in the world. But we have a strong presence, actually, overall in Asia. We are managing a business of $400 billion USD of assets, and with a strong presence in terms of staff. Today, our friends from Endowus invited us to share with you some of the findings of studies that we have been running across European and Asian investors on how they are investing, and most importantly, what we can learn from it. Early in summer this year, we have been discussing with roughly 5,000 people across 12 countries to understand their motivation to invest, how they were investing, and how we could help them on those investments. And the idea today is to share the finding more specifically on investors in Singapore and what we can learn from the wealthiest investor and what we can apply to our portfolio, whatever the size of the portfolio is. So, to start with, we do see that the amount of investable assets in Singapore is quite significant. It is actually higher than most of European countries. And if we are looking more specifically into the wealthiest part of investors in Singapore, they have much more investable assets than they do have in Switzerland. Very, very interesting to have in mind. However, when we look at the percentage of assets effectively invested in Singapore, part of this investable asset, it is smaller versus what we observe in other countries. So it means that European investors are putting their money at work harder than Singaporean investors. But having said that, this figure is actually very dependent on the level of wealth of investors. Basically, the wealthiest the client, the investor is, the highest proportion of investment he is making of these investable assets. Concrete example, investors with 500K of investable assets tend to invest 50% of their assets, where people with 50K of investable assets tend to invest less than a third of their assets. So the first thing is really, when you are able to invest, do it. Then we did focus on why investors are investing for. Always the same, what we are observing across countries. It is about long-term goals, long-term objectives, retirement, first of all, financial security, even for people in their 20s. However, what we do observe in Singapore, that first of all, return is extremely important on the one hand, and on the other hand, stable income is something which is of the highest importance for investors in Singapore. Interesting statistics when we are asking to investors what are the features which are very important to you when you are choosing investment products. And we see that the wealthiest investors do pay a very close attention to the fees. The fees is the most important aspect for those investors. And actually, when building a wealth, we know that from a long-term perspective, with a long-term objective, the fees are going to have a huge importance on the performance overall of your portfolio. And this is something, once again, that needs to be monitored carefully, and the wealthiest investors spotted it very well. Well, when it comes to investment, what the wealthiest Singaporean investors are doing. First of all, and this is very striking on this slide, is that we do see that the portfolio of the wealthiest investors are very diversified. For example, people with assets above 1 million are using 3 times more passive fund versus people with an average wealth on the one hand. And on the other hand, we do observe the same on active strategy, active funds. They are heavily using them as well. When we look at early investors, we do see that they are focusing much more on direct investment, cryptocurrency as well, and this is less diversified. So we could learn from it actually that I would say to build the wealth, diversification is absolutely key. And having on top of direct investment, crypto, adding some professionally managed fund or passive fund might be a good idea to build a sustainable wealth. And important today, those professionally managed funds or index funds have never been so accessible through digital channel like Endowus is offering. Okay, speaking about digital, here we do see overall that in Singapore this is definitely a digital nation. 72% of investors are using digital tools to invest, whereas we are much more in the area of 60% in Europe. While the wealthiest investors have still traditional advisors and way to invest, they, on top of it, are using robo digital platform in order to invest part of their money. And we asked why they were not entirely relying on traditional advisor. Is on the one hand, investors in Singapore do figure out that they can find a lot of information through platforms regarding investment fund that they are looking for in terms of strategies that they want to get on the one hand. So the access to information is very good. And on the other hand, some of them, I would say, do not enjoy really a strong value added of a traditional advisor. That's why we do see this trend on the digital side on top of the traditional way of investing. So then we asked what are the benefits of digital tools, and there are 2 main elements which are coming back. On the one hand, we do see that finally the wealthiest investors like to have control of their investment. They like to be, I would say, in the driving seat, being able to select and to choose their investment on the one hand. And on the other hand, it's also something which is very interesting, is they do appreciate the flexibility of digital platform in terms of smaller amount being able to be invested on a regular basis, and this, I believe, can be applied to most of us, regular investment with smaller amount. So, to conclude, and I would say what we can learn from this study, and the idea was kind of having the tips on how to invest like a millionaire, if I might say. So, first conclusion is, if you can put your money at work, coming back to the first slides, do it. Put your money at work harder. That's one. Second, you need to diversify your portfolio. Now you have access to a broad range of strategy through a digital channel. You can mix between passive, active, crypto, direct lines, and this will build a sustainable portfolio. Cost, extremely important over the long run. It will impact significantly the overall performance and your overall wealth. So this is something that you need to pay a close attention to. And to conclude, we do see that digital platforms are today offering a wide range of benefits, flexibility, wide offering, low cost, able to be in the driving seats to select your strategy. So you need to take the most of the benefits of the digital player like Endowus. I will stop here. I hope this has been interesting to you. Wanted to share some of the elements of the study, and thank you very much for having me.
Thank you very much, Gaetan. Wonderful insights for all of us. Short, sharp, and sweet. We loved it. Thank you so much. So what I got out of that, which I'm sure you did too, is that Singaporean investors are knowledge seekers. They are not just knowledge seekers, they're very self-empowered, digitally savvy, and they're both modest and can be aggressive investors. So I love it. We've got it all. All right, so we are moving on to the second lucky draw of the day. After we've talked about investing. And the winner will receive an ErgoTune gaming chair. Has anybody got one of those chairs? Anybody in the room have one of those ErgoTune gaming chairs? You do? Is it great? So there you have it. So if you win it, you already have someone saying it's great. They're advocating for it. It's worth $820, and I know that apparently it just feels like a dream, like you could actually sleep in it. Is that correct, sir? Yes, have you slept in your chair? You have, I thought so. All right, spin the wheel. Let's see who's going to be sleeping in their ErgoTune $820 chair. Go for it. It's coming, it's coming. Oh, I can see it here. Okay, there we go. Click to spin. And our winner is Kyungju Hong. Are you in the room, Kyungju? Oh, wow, there you are. No, that's not Kyungju. Oh, that's fair. Look at it. Endowus in action, being fair. All right, let's spin again. Eddie Tan. Eddie, are you in the room? Eddie, come on up. Eddie's sitting right behind the gentleman who already has the chair. You can ask him all the details. Please come up and receive your prize. Congratulations. You now have an ErgoTune chair. If I go on Carousel and see it tomorrow. Congratulations, Eddie. Thank you very much, Sinteng, for giving this prize away. Fantastic. We will have one more lucky draw a little bit later on, and that's the big grand prize. Ladies and gentlemen, our next panel discussion is the ultimate, this is really great, I am going to be all ears, the ultimate CPF and SRS explainer. Everything that you should know about your CPF and SRS and how they actually work. Please put your hands together for our moderator, Min Axthelm. Min Axthelm. Come on up, guys. Head of Investment Research at Endowus. And the panel speakers on stage for the next panel. Gerald Wong, founder and CEO Beansprout. Geraldine Finin. Geraldine, did I say that correctly? Geraldine Pia?
Yeah.
Wow, beautiful name. Content creator and Endowus client. And Timothy Ho, co-founder and managing director, Dollars and Cents. Whose little girl? Is that your little girl?
That's mine.
She's great. She's sitting in front of us and she's humming to herself. Ultimate. It's absolutely beautiful. I'm so glad that you brought her with us. Take it away. Min, sorry.
Thank you.
Thank you.
Yeah.
Take it away.
Okay,
All right.
Thanks. Hi, everyone. Good morning. Thank you for spending your Saturday morning with us. I'm sure you're all very excited about the CPF panel here. The topic of CPF is very near and dear to every Singapore citizen and PR's hearts. And it's also something that we often get asked by our clients. So here are some fun facts about CPF, if you don't know already. There are 4.5 million CPF members as of June of this year, $556 billion in CPF balances, and about actually 31 billion in CPF OA and SA is invested. And just for 3 months, specifically from April to June of this year, there was an inflow of $12.1 billion. So that's the kind of numbers that we're talking about. So today we have 3 panelists here. You're already familiar with these panelists and their faces. They're quite famous, I think. Geraldine, and Tim. So to kick it off, maybe if you could just introduce yourself very briefly and talk about the life stage that you're in, maybe the age group that you're in, and if you're comfortable sharing a little bit about your personal circumstances. It doesn't have to go into details, but so that the audience can understand and kind of relate to where you are.
Okay, I'll go first. So I'm Timothy, so I'm co-founder of Dollars and Cents, so it's a finance website. Some of you may have read some of our articles. I've been doing it full-time for about 8 years. So currently, I'm married, 3 kids, so my oldest is actually there, 6 years old. And yeah, there's another 2 younger girls as well. So I'm pretty much in the sandwich generation as well, meaning that I have elderly parents as well that live very close to us as well. So that's currently my life stage. Yeah.
Geraldine?
Hi everyone, really glad to be here. So if some of you have some issues pronouncing my family name, is actually Pia, so you can think of it as like Tau Sa Pia, Po Pia. So that's the best way I get people to remember my last name. So a little bit about myself. So I'm a content creator and I create content around how millennials can actually accelerate our growth while staying balanced. So topics I cover would include work, money, well-being, and anything that is actually relevant to those who are in my age range. In my day job, of course, I worked in the software as a service industry, so I'm in tech sales. Right now, I'm at a Series D AI market intelligence startup that is actually headquartered in the US, but we're helping to launch their APAC office here. A little bit more about myself, I guess. I'm not blessed with children yet, like Timothy, but hopefully soon one day. Yeah.
Thank you.
Hi everyone, my name is Gerald. I'm the founder of Beansprout. Like Dollars and Cents, we are a financial insights platform to help you make better financial decisions. Prior to starting Beansprout, I was actually working in a bank for about 12 years. The bank is no longer in existence, but part of one of the platinum partners today. So when I was there, I was fortunate to be able to actually build my retirement savings, and with that actually leave the firm about like 2 years ago to start Beansprout, so as to be able to help more retail investors actually make better financial decisions. So at this point in time, I'm about to hit 40, not married, and because I just started this business, just being able to have the peace of mind to do what I want to be doing, to be able to live in line with what my values and beliefs are, is actually something that is very important.
Thank you. Thank you so much for being very open with us today. So maybe we'll start off with the first question, and this will be for all 3 panelists. Why should the average person care about CPF and SRS? And what's the big picture benefit for everyday Singaporean? Who would like to start first? Maybe Tim?
I'll go first.
Yes.
I think the average person has a lot of money in their CPF savings, right? Whether they know about it or whether they don't know about it, right? For many people, the first time we think about CPF saving in Singapore is typically when you need to buy a HDB flat, whether it's on the resale market or you go to the Toa Payoh and then you buy a BTO flat. That's where you realize, oh, okay, I actually have this amount of money in my OA, and thankfully I have the money in my OA because now I can pay the down payment and I don't have to fork out so much cash. So clearly, CPF saving is a very important part of our investment, of our portfolio that we may or may not see. And the next time, for a lot of other older Singaporeans, When they'll think about it is when they're about to retire. And that's where they would typically, I mean, I have both my parents are using their CPF savings for their retirement now, and typically they will only know about their CPF savings when they're about to reach retirement. They just see how much they have, and then someone in the CPF office will tell them, okay, this is how much payout you would have. But in between, there's about 40 years time gap, right, from the time you start working till the time you retire, age 65, which you may not do a lot of things about it, but just by optimizing your returns a little bit, you can actually get a much higher return. So I think that is why CPF savings is important, but quite often we don't put as much attention onto how to fully maximize our CPF savings until maybe it's a bit too late, right? So if you think about it, at age 60, it's about too late already because you can't do much at that point in time.
I guess a lot of people know about CPF because every month when you look at your pay slip, if you're a Singaporean or PR, you will see some amount of money being deducted, and that's how people first get to know about CPF and what it actually does, because they will go online to research about the scheme. What is less commonly known, I find, at least for my generation, is actually the topic of SRS. So for those of you who are not familiar with SRS, it's basically like a voluntary tax advantage savings plan that's actually offered by the Singapore government. And the catch here is that both foreigners and also PR and Singaporeans, everyone would actually qualify for it. For SRS, there's a cap every year, 15,300 for citizens and PR. And for our foreigner friends, that is actually higher, it's 35,700. So Tim has already explained some of the key benefits of CPF and why you should care about it. So I'll cover the portion on SRS. I find that to neglect SRS as a working adult is really a missed opportunity, because it's actually a chance for you to really be able to reduce the kind of annual taxes that you have to pay, and at the same time to be able to tap on this method to kind of build wealth, which we'll cover quite a bit on later.
Thank you. Gerald?
So I think, like Geraldine shared, when we think about CPF, it's always towards the contribution side. We think about how much our take-home pay will be lower because of the additional CPF contribution. But I think what I try to do is also think about what then do I use the CPF savings to be for, especially when it comes to my retirement planning. And I think why is it very important is because a very big part of our savings actually is within CPF. So if I want to be thinking about how I can maximize my retirement savings, definitely that is the first part that I'll think about how I can optimize it.
Okay, thank you. Great panelists, because they just moderate themselves. They go over what they've already covered, so I don't have to do much. But I think how we're going to take today is we'll take some questions during the panel discussion instead of leaving it for the end. There is a question that has the most number of votes right now, and that's actually about SRS and individuals in lower income tax brackets. Is it worth putting money into SRS for tax savings?
Let me just share. So for those of you who don't know SRS, basically what you do is when you contribute to your SRS account, the amount you contribute is less off from your income tax, your taxable income essentially, right? So if I have a taxable income of 100,000 and I contribute 10K into my SRS for the year, my taxable income becomes 90,000 for the year, right? And of course, for those of you who are fortunate enough to pay income tax, you also know that income tax is progressive, right? So at the top end, you are talking about 20 or 22%. And of course, you know, if you, at the lower end, it's much lower. So the whole idea is that SRS makes more sense to top up as your income becomes higher, right? Because then the tax savings that you enjoy is also greater as compared to someone who is paying lower income tax and they are at a lower tax rate. So, yeah.
Thank you. Anything else you'd like to add from the rest of the panelists?
Yep, I guess Tim is right. You know, it does make sense to perhaps maybe explore SRS as an option a lot more as your income grows. But I would still encourage, young adults in this audience, since there are many young faces here, to still pay attention to this, because you'll be surprised how much, you would be able to enjoy growth in income, along with your growth in your skills and marketability, in the first maybe 10, 15 years of your work life.
And for Gerald, I have a special question for you. How can we balance using CPF and SRS effectively to plan for retirement?
Okay, maybe I'll take a step back by just painting the overall picture around how I would think about CPF versus SRS. So I see a very wide range of audience that's here. We've got like audience from 6 all the way to our young seniors. So I'm not sure how many of you are familiar with Doraemon, the Japanese cartoon. Okay, so effectively, if you know what Doraemon is, effectively this Japanese cartoon that has got a pocket where, depending on the different circumstances, there'll be different tools that will be put up. So that is effectively how I'll think about the different aspects of CPF as well as SRS, in which each of them would effectively be serving a purpose, and I will use them accordingly. Okay, so if I think about CPF ordinary account or OA, that would effectively be the foundation. And as the name suggests, ordinary, that also allows you a broader use of applications, including, say, purchasing a house or being able to apply for BTO. If I think about the SA, that is special. And what it means by special, at least how I'll think about it, is that I'll only think of how it has a certain special use when it comes to the SA money that I've effectively put aside. And then, like they have explained earlier, for SRS, effectively, it is a voluntary scheme, but because it is voluntary, the interest that comes along with whatever you have put aside for the SRS is lower as well, at 0.05%. Okay? So that is effectively how I would differentiate between the CPF OA, SA, as well as SRS scheme. And using that framework, then it becomes easier to understand how I would segregate my investing between the different pots, because effectively for CPF OA, the barrier to investing is much lower, given that you are looking at a 2.5% interest rate for your CPF OA, and the range of investment options that you have will be wider as well. Okay, for SA, because you are getting now 4.04% interest rate, so the bar to investing is a bit higher, and the range of investment options that you have would be more limited as well. Okay, for SRS, it is entirely voluntary. I would think of it as like a step up, because you are wanting to do more for your retirement. You are putting aside even more of your income for your retirement planning needs. But because the interest rate is 0.05%, then you really need to think about what investment options you want to be taking for your SRS money.
Okay, very helpful. Thank you. So maybe this question would be for Tim. What are some practical tips or rules of thumb for someone who wants to start investing in their CPF money? How would you get started if you were to invest?
I think the first thing to just note is that you don't want to start investing your CPF savings, your CPF OA savings in a way that's very different from how you would typically already invest your regular cash, right? I may not be super old yet, I'm in my mid-30s, but I can actually remember when I was young, a lot of the older people around me, so they would be your pioneer generation, young seniors today already, I guess. What they do, and back then, is that a lot of them actually use their CPF OA to invest in stocks, even though they don't typically invest in stocks using their own cash. And the reason for that is simple, right? Because they don't have a lot of cash on hand, hence they don't invest. But then because their CPF OA savings feels like it's just an untapped portion of money that they could easily use to invest / trade / gamble, whatever you want to call it, they deploy it that way. Right, and unfortunately, because most normal people who don't invest will not be very good in stock picking or investing in individual stocks anyway, they end up losing money on their trades. And then that brings the whole cycle of, hey, you got to be very careful when you invest your CPF OA because that's your retirement nest egg and that whole argument there, right? So I would start by saying that, firstly, you should not be investing your CPF money in anything that you wouldn't typically already think about investing your cash for, right? It's an extension of your overall investment strategy, not a different investment strategy. The second thing to note is that CPF savings, when you invest, typically you're looking at a longer term horizon, right? So you obviously cannot make trades. You shouldn't be investing in 3 to 5 year time frame. You want to think about it, in my opinion, 10 to 20 years, because that is for your retirement. So if you are 35 like me, you got 30 years to retire. So, at least you're looking at a 20 years time frame. I think that's generally better. The third thing is, of course, to minimize costs, right? This is very important because a lot of people don't understand, but the thing about CPF returns that makes it so valuable is that you get the return, whether it's 2.5% or 4%, cost-free, meaning that you don't pay anybody to get that return, right? So if you were to invest your CPF savings, you are incurring a cost, a transaction cost, an asset management fee, and you want to make sure that this cost is minimized so that you don't spend more than you need to grow your savings. Otherwise, what's the point of getting a 5% return, but you pay 1% in costs? You may as well just transfer it to your SA, right? So I think that's the three things I would consider.
Very sound advice, thank you. Anybody else would like to add to what Tim said? Or no? Okay. So we can move on to the next question. So this one has also a lot of votes. And so I'll direct it to all three, whoever wants to take it. Do you think the government will clamp down on SA shielding?
Oh.
That's a difficult one, I imagine. But, I mean, maybe we can start by explaining.
Should have asked Heng Swee Keat yesterday.
Yeah. Sorry, guys, wrong panel for the question.
You ask the next panel, Christopher.
Yeah. Maybe we'll skip that one then?
I can explain the shielding.
Okay, sure. Let's explain the shielding.
Okay, so shielding is, I am not a 1M65 expert. I know some of you guys may be. I'm not, but I roughly know what it means, right? So basically, what people want to do is that they don't want their CPF SA to go into their retirement account. So before they turn 55, and the next panel after me can correct me if I'm wrong, they put it somewhere else so that it's not tapped, it's not touched, right? Then after that, they transfer it back. So that is the shielding hack. I guess you could say that it's a workaround, which, the government may or may not like that to be in place. I personally think that, with the SA funds, you're talking about a 4 to 5% return if it goes into your retirement account. So that's actually quite valuable, and I personally would think that it's I think we can just let it be currently.
Yeah. Okay. Okay. Good answer. Hope that answers the question. So maybe for the next one, let's go to Geraldine. Maybe what are some of the myths, for investors in your generation and life stage about CPF investing that you would like to debunk?
Well, there are many myths regarding CPF and a lot of misinformation, but of course to give them credit as well, the organization has been taking a lot of steps to clarify and simplify a lot of these complicated concepts around the scheme, to really break it down so that, into things like infographics, blog posts, videos, so that the younger generation is able to digest it better. If I were to point out the most common misconception or myth or misunderstanding of CPF, I would actually think it's the fact that it's being completely ignored or out of picture when it comes to financial planning for many in my generation. So assuming someone is maybe not at a stage of intending to buy a house yet, or perhaps maybe is not someone who actively looks at their finances and their portfolio, there is a tendency among some of my peers to simply not even see CPF as part of that, right? And that's a huge missed opportunity because, as Timothy pointed out earlier, there is a significant sum of money that accumulates, and then with interest it actually grows. And at the same time, while you are young, in your 20s, in your 30s, to not invest that amount of money, be it CPF or SRS, could be a missed opportunity for yourself, especially if there's a huge sum lying there. So I'll just give you an example. SRS interest rate is only 0.05% if you do nothing, right? So that means to say that, you can just count the compound interest at the end of 10 years. That's not going to be very sufficient. Therefore, it's really important to think about, since you have that money sitting there, what are some of the ways in which you can help it to grow faster, and not be suffering at a percentage of 0.05%, because that's really missing out on the potential gains that could have been incurred. Similarly, for CPF itself, 2.5% for ordinary account, that could be good for some people, but I believe that, perhaps as young, educated people, there are so many much more options out there which could help you perhaps maybe accelerate it. So even if it's 1% increase in interest rate, that could really accumulate into a much larger sum over a period of time.
Okay, thank you. That's great.
If I can just add to that, I think basically for a lot of young investors, we may not think long-term enough around our retirement planning, and that probably explains why many people do not think about using their CPF to invest. But on the flip side, we also see that some may think a bit too short-term when it comes to using their CPF money. We interact with a lot of retail investors, and I think one of the most commonly discussed topics in the last 6 months is Singapore Treasury bills. For those who are still not aware what Singapore Treasury bills are, they are MAS issued government bonds that allow you to earn a safe return through this government bond. Okay, so the thing to take note of is if you are actually investing in a treasury bill that may be 6 months or 12 months, and there is no certainty that we are able to get such a high interest rate 6 months or 12 months down the road when the T-bills actually mature. So that's something that we constantly highlight, that while they are relatively safe in terms of being an investment product, you also bear a certain reinvestment risk when you do not think long-term enough for your retirement needs.
That's an excellent point. Thank you. So maybe for the next question, I'll go back to Tim. As a husband and father, a family man, what are your thoughts on how you proportion out different, your CPF funds for different purposes, such as using it to pay for, the down payment for the house, or also for investments for retirement? What's your framework for that?
Yeah, so I think our CPF OA is generally quite valuable for us in fulfilling some of our needs in our life, right? So the first thing that, as I shared earlier, that most people think about is to buy a house. And that's certainly true, whether you're buying your first flat or you're upgrading to a private property. A lot of us would somehow dip into our CPF OA to help with the down payment or the monthly installment. So that's the first need we have. The second need is, of course, our own retirement, right? So we, as much as we want to take some money from our OA to pay for our home, we also need to set aside for our retirement, right? So you have your special account, so that obviously is untouched, that compounds at 4%, but your OA is also forms part of your potential retirement nest egg. And then the third thing is, of course, can you invest the money as well to get a higher return? The way I look at it is that it's not about choosing one over the other. We should strike a balance. I share with you what I do, all right? So for myself, we upgraded to a private property about 2 years ago. So a fair bit of the down payment came from the CPF OA that we have, as well as the monthly installment, right? But what I do is I also keep a huge, I wouldn't say huge, a significant sum in my CPF OA because I'm an entrepreneur, so I'm always afraid that I'll lose my job, the business will close down. So what happens is that your home monthly installment has to be paid for, right? So I make sure I set aside a couple of years worth of mortgage that can be used to cover the housing installment in the event that I lose my job, right? And I think that's important as a dad because you need to make sure that if anything happens to you or your job or your company, that your family doesn't have to move out within a year, that you have enough money in your OA to still pay for the mortgage. So you want to set that aside as well. In my younger days, what I did, because that was back then when I was still staying my HDB, this was during the MOP period, so I know I was not going to sell the house anytime soon. I actually, for some of the years, I actually transferred my OA to my SA because what you want is that you want a little bit of a higher return. So I always say that OA 2.5%, SA 4%, right? So if you talk about making your money work hard for you, even within the CPF account itself, not every saving you have is working as hard for you, right? The SA is obviously working harder than the OA. So what I do is if there's excess saving, I transfer it to my SA. And today, what I do as well is that the excess savings I have in my OA, so money that I don't think I need to set aside, or rather, I've already set aside what I need for my monthly installment, but the additional amount money that I have in my OA, what I do is I invest it as well, right? Because you can get higher returns right now from the market. Gerald talked about the T-bills, right? Even the T-bills can give you 3.7%, that is like even Singapore government securities also give you 3.7%. That just means that the 2.5% in our OA, it's good in the past when interest rates were low, but it's not good today when interest rates are much higher, right? So I do invest in it. I do put some of the money in the Endowus CPF portfolio because I also believe that over the next 20, 30 years, it will compound for me. So I would say that there is a good allocation across housing, retirement, which means retirement from the point of view of CPF retirement, as well as investing as well.
Okay. Maybe I can add one point about the housing portion, because that kind of resonates with me. When it comes to, using your OA for housing, I guess some property agents would kind of talk about how you can actually, just max out, right? And use everything. However, it's very important to take into consideration also your life circumstances. So Tim is an entrepreneur. For myself, I work in a very volatile industry that is on the news headline for layoffs almost every single week and month. So that's the tech industry, right? And I think that to really max out if you come from a volatile industry is not the wisest thing to do. So what I did, with my property was really to have that kind of margin of safety as well, to be able to tide myself through if in a situation when I was laid off. And earlier this year, I think it was in June or May, I was actually let go as part of the wider company layoffs as well. And having that kind of buffer in the CPF actually provides a huge margin of safety. And that also impacted my interviews, right? Because when I go for job interviews, it's more like, I'm in a very relaxed state because I know that I have a huge runway that I can actually rely on, both from emergency funds and also a CPF OA perspective. So do remember margin of safety, and I do not think that is great advice for anyone to just max out their OA deductions when it comes to property purchase.
Yep. Yeah, so it really depends on which life stage, which industry you're in, your objectives.
Yep.
So, anything to add, Gerald? Okay, no. So maybe we can go to one of the audience questions again. There are actually a lot of questions. So. This one, if your friend comes to you, so this is for all three of you, if you're comfortable answering, and they said about 70% of people who invest their CPF actually make losses or make less than the OA interest. Does it then make sense to forego this guarantee return? I'm not sure where the 70% is coming from, but that's the question that's being asked.
Most people that I know invest their CPF OA in individual stocks lose money. So in a way, if you're looking at that percentage from that point of view, that they are investing in individual stocks over a time period of, okay, when I say time period, it doesn't mean that they stop investing after that. It could be that they just invest in a stock, then they sell 2 days later, 3 days later, right? But they might do that for many years, right? But the individual holding period is very low. They do lose money, right? It is because they do not take a long-term approach towards investing, which is why that statistics show. The other possibility is that the cost they pay is too high. So in the past, for those of you who are old enough to remember, the rep fee for CPF can be easily more than 1%, right? That means the fee that the financial advisor charge you to manage. Today, the government has kept it at 0.4%. So that is at least a reduction of 0.6, if not more. And that kind of percentage point is very important in determining whether or not you can outperform the market or you can outperform what your CPF SA could have given you.
Thank you. Anything else to add for?
Maybe I will go back to what Tim shared at the start, which is that for many investors who are, say, starting to invest in single stocks, that is something that we just need to be aware about, in that there are actually different investment styles and different investment products depending on your individual lifestyle, your level of knowledge towards investing. And I think that statistic probably reflects that there might be some investors who might be, say, picking single stocks when they might not have the knowledge to do so, when they might not have the time to be monitoring their investment. In which case, I guess with the proliferation of different products in the market today, with the birth of different platforms, you now have a wider range of options that suit your individual lifestyle, risk appetite, and level of knowledge towards investing. So I think even if you realize that you might not be able to pick single stocks by yourself and risk actually making that kind of returns, then you can actually explore other options such as more risk-free or lower risk kind of options or things that doesn't require you to take such an active approach towards making your own investment decisions.
Very good points. Geraldine, you have something to add? Okay. So if I can just summarize what Tim and Gerald said, really it could be that the percentage of people who invested their CPF who actually had losses, they could be invested in something really risky, and they could have a shorter term investment horizon. So as long as you are investing in something that's maybe more in line with your risk tolerance and with a longer investment horizon, you could potentially exceed this OA guaranteed return.
I just want to highlight that in the past, this is 20, 30 years ago, the investment options available for CPF OA is generally more limited and the fees were higher. So it's quite unfair/unfortunate that the older generation, they just didn't have as many options as we have today, for example, robo-advisors. So they had very little options besides, single stocks on the exchange. Even ETFs back then were very, not often, right? I mean, Gerald would probably be more familiar. Yeah, so they actually were investing in a very different climate as where we are today.
Okay, thank you. Hopefully that answers the question. We have a few minutes left, but I'd like to take this time to ask each of you, if you're comfortable sharing, how are you currently invested for retirement? You don't have to say specific products, but more like your asset allocation. How are you thinking about it? Gerald, would you like to start?
Okay, so I think when it comes to retirement planning, it comes down to two things. Number one is to think long term, because effectively we are thinking about what's going to happen 20, 30 years down the road, and it is not something that, like I mentioned earlier, just thinking about whether I'm earning a higher interest rate, 6 months or 12 months, and I think that requires us to sit down and understand what are the different options that allow us to make this return at the point when we are retiring. And then the second point, I guess, is what Tim has already made earlier. It needs to be a low-cost option because this cost actually gets compounded over time, and we want to make sure that when we are investing for the long term, it is something that doesn't come with too significant cost. So I think those two would be the key tenets of how I would think about my own retirement planning, and the choice of platform, the products that I'll actually choose would effectively be in line with these two key objectives.
Personally, I'm still trying to figure out this question. In fact, every time I meet someone from the finance space, I'll be asking them, actually, what's the ideal asset allocation that someone of my age and profile should have, right? And then the question I'll get would be more like, oh, it depends on your lifestyle. But here's what I'm doing currently. I have a spreadsheet, and I'm happy to send it to you if you would like a template that I use.
I would like
Google Sheets. Yeah, and basically every month I track okay, how much is in each of the different bank accounts. Am I invested in for my different investments, and also what's happening in my CPF and all that. So I get a complete dashboard of what is actually happening at that point in time where I log in the data as well. So I guess it's very important to start with measuring, because if you don't measure, you don't know the progress that you are making as well, right? And I also track my net worth every quarter just to see okay, is it trending up, and if it's trending down, then that's kind of a problem that I probably should look into. So I guess start with measurement, and then something else to take note of is also, of course, your lifestyle as well. So I'm very time-starved these days, so therefore I started to take a much more passive approach to investing versus an active one, because stock picking is good if you are great at it, but you just imagine if you invest in one stock, then you need to watch their earnings call and keep updated with what they are doing, and not just them, but also their competitors as well. So that actually takes up a lot of time, right? Assuming you spend 3 hours to study one company, then if you study their competitors, so that will take about 15 hours every month or so. So that's really quite a lot of time. So I don't really have that luxury, and therefore I've actually chosen a much more passive option, for example, funds, private debt and all. Yeah.
Okay.
For me, I just like to have different paths to success. So I have this thought, which is that I don't need all the paths to work. I just need 1 or 2 to work, and I'm okay for my retirement. So the different path of success is my CPF. So I make it a point to keep money in my CPF, top up my SA whenever I can as well. I also invest via robo portfolios, because I also have the time to look at my investments, but I don't want to do all of it my own. So I also use the robo portfolios as well. I also invest in individual stocks and ETFs because hand itchy sometimes. You read too much, you also want to invest, and you think you know something the market don't, right? Property is always a play for us in Singapore, and for me, there is a strategy as well there. And then lastly, of course, business building lah. So, investing in my own businesses or looking at other investment opportunities within the business world. So like I say, I don't need all of it to work. I just need one or two to work. That's good enough, right? So I try to have different paths to success.
Thank you. Very interesting. Different strokes for different folks. We're almost at time, so I guess, yeah. So I think that's it. Well, thank you so much, everyone. Thank you for joining us today.
Thank you very much, Min. Thank you to our wonderful panelists who had such a variety of opinions and ideas and strategies. We're just going to reset the panel. A few takeaways that I put down was CPF just often gets ignored. And I think there are reasons for that. I think a lot of the times it's not very well explained. Hopefully, some of the explanations that you've actually heard on stage today make sense for you. I do think that it could be better explained by CPF itself. It is definitely an opportunity. Another point that came across is that the special account is special. Go and have a look at it and have a re-look at your special account. Just a couple of observations just for myself as somebody who is a new investor and who's really coming into this at a different point in our life. I think we have to remember our lives are not linear, and the advice that we need is different at different points of our life. And so what I would like to propose, and to the industry as well, is that you also need advisors and advice and people who are interested in people who actually bloom later in their lives. Because we're not all necessarily thinking of the same things when we're in our 20s, in our 30s, and our 40s. At my point in my life, I'm actually now thinking about investing. And you also do need people who will talk to you about and manage your expectations as well. What do you say, right? We're not all just going to be investing only at the same times in our lives. So that's my shout out to the industry to also provide information for people at different points in their lives. Okay. Our next panel is Alternative Investing 101. What makes these asset classes different? And please join me in welcoming on stage our next panel speakers and moderators. Our moderator is Cheryl Chung, Head of Client Advisory at Endowus, and they discuss, as I've said, Alternative Investing 101, what makes these asset classes different. Please, of course, join me on stage, my panel. Melanie Wong, Head of Wholesale Client Coverage, Southeast Asia UBS Asset Management. Please, a big round of applause. Pin Lorjin Dakul, Partner, Lightspeed Venture Partners. Dominic Piccone, Managing Director and Partner, Co-Head of SE, Southeast Asia TPG Capital Asia. And Jeremy Sung, GM Corporate Finance and Strategy, MDAC Global and Endowus Client. Over to you, Cheryl. Thank you.
Thank you. Just checking, can everyone hear me well? Good, thank you. Thank you all for spending your Saturday with us, your precious Saturday morning and afternoon. We have the pleasure of being the last panel for this conference, and we'll be touching on the topic of investing, in alternative investing. So what exactly is alternative investing, or alts, as we know, short form as alts, right? So it's not a traditional asset class, as most of you might know of like equities and bonds. It tends to be illiquid in nature and also not publicly traded, and higher minimums when it comes to investing. But there are many people, like for example, pension funds and also endowments and also high net worth individuals have always been investing in this space. And as you heard in the previous panel from Joy, she also mentioned that pension funds have allocated 20% and even up to 40% into alternatives. So in recent years, a lot of individual investors have garnered interest in this space. And that is largely because platforms such as Endowus have started offering access into alternatives. And also, secondly, there have also been, fund houses that have been providing Hi. Okay, I'm back. Yeah, so fund houses have also been providing semi-liquid structures to make, everything a bit more liquid, and also having, the funds registered for retail audiences so that more people can actually invest into it. So before we begin, maybe I'll hand it over to the panel to do a 30-second round of introductions before we begin. Over to you, maybe Melanie first.
Sure, thank you so much, Cheryl. All good on the mic?
Yeah, all good.
Very good afternoon, and thank you for having me here today. My name is Melanie. I'm from UBS Asset Management. I've been with the firm for about 8 years. In the early parts of my career, I cut my teeth as a financial advisor at the local banks. I've spent about 8 years working in local banks and another 15 years with asset management firms. So indeed, a pleasure to be here to speaking to all of you today.
Thank you, Melanie.
Hi, everyone. Hi, my name is Pin, and I'm a partner at Lightspeed Ventures. We invest in startups like household names that you hear today, like Grab, Snapchat, Oyo Rooms, but 10 years ago, right? So it's an asset class called venture, and it is a very high-risk one, so I'm happy to share more today. And as a full disclosure, we are also an investor in Endowus, so to the extent that I should disclose that, and also that I'm not a certified financial advisor, but I'm more than happy to share how, at least for me as a venture investor, I kind of manage my personal portfolio. So glad to be here.
Good afternoon, everyone. My name's Dominic, partner at TPG, based here in Singapore. I've been with the firm 18 years, which has been my entire professional investing career, and these days co-head our business in Southeast Asia. TPG is one of the world's largest alternative asset managers. We have about $150 billion under management, mostly in what we would call private equity, and as we talk more this afternoon, we'll unpack a little bit what that is, but good to be here.
Hi, good afternoon, everyone. My name's Jeremy, and I'm the General Manager at MDAC, covering corporate finance and strategy. MDAC is a B2B focused fintech, specially focused on cross-border transactions in foreign exchange and payments. So prior to moving into fintech, I spent 18 years as an investment banker, looking after Southeast Asia, doing IPOs and M&A. So I'm an avid investor, and I'm also an Endowus client.
Yes, I'm pretty sure everyone will find you familiar, Jeremy. You're an Endowus advocate as well. Yeah, so Melanie, if you could start us off, could you maybe give us, an introduction of, what exactly is this asset class alternatives? How does it differ from traditional asset classes that we're more familiar with? And also, how can clients or investors think about adding this into the portfolio? When do they start adding this into their portfolio?
Sure, and Cheryl, as you alluded to. Cheryl? Cheryl? Yeah, thank you. I think the mic is going on an early weekend break.
Yes, it is.
So yeah, Cheryl, as you alluded to earlier, in terms of alternative investments, when most of us think about investments, we tend to think about traditional financial instruments like your bonds, equities, but that is actually a whole array of alternative investments that are actually unconventional securities. You have, for example, your private equity, hedge funds, commodities, as well as private debt. So I'm going to break it down in terms of 4 by 4 to everyone. So there are actually broadly 4 common alternative investment strategies. The first one is private equity. Private equity, as the name suggests, is private, is capital invested into unlisted, where you get actually a premium over equity or ownership. And at the same time, investors who invest in private equity they actually get higher returns at the same time. The second option is, the second alternative strategy is private debt. So similar to private equity, this is actually capital invested into debts of companies. So managers invest in private debt to restructure debt, to also restructure default debt, for example, as well. The third category is real estate. So real estate in terms of residential, commercial, industrial types of real estate, either in primary or secondary real assets. So as for managers like us at UBS Asset Management, we invest in real estate via a variety of areas. For example, we can buy into properties for refurbishing, we can buy into properties for development projects or repositioning projects, and this actually has been known as a good inflation hedge for investors' portfolios. The fourth category is hedge funds. Now, I'm not sure how many of you are born in 1949, or most of us were actually, if I look across the floor, many of you are not born then. Now, Alfred Winston Jones, he's the man, if you Google it, he's the guy who created the hedge fund strategy in 1949. And why he did that back then was because there was a lot of uncertainty amongst economies, how the markets would turn out. And his idea behind developing a strategy was to have a strategy that is not correlated to markets and to generate stable returns. So his approach was to do something very simple as buying into unvalued companies, right? And also short sell into overvalued companies. And with that, he's actually taking a profit from the difference between the two. Now, this approach is actually designed to have returns that's uncorrelated to the market direction, as long as you're buying the right stocks, as long as you're buying the right companies. And that's how the word hedge originated. And that's how hedge funds, since this was launched in the first launch was in 1949, we have seen trillions of assets in assets under management for hedge funds. And today we have easily about 10,000 hedge funds being created. Now, so 4x4, I've talked about the 4 categories: private equity, private debt, real estate, as well as hedge funds. Now, I'm going to also briefly talk about the various types of hedge fund strategies. Now, in hedge fund strategies, as I mentioned in the example earlier in terms of buying into undervalued companies and short selling overvalued companies, that is actually an equity long-short hedge strategies. On the credit aspect, the second area, we could also do the same thing, except that you actually long and short into fixed income securities, credit. The third is actually on, we call it relative value. Now, relative value, RV as is known, in short, basically is where arbitrageurs, they look for mispriced assets. They buy into assets that are mispriced, hoping to take advantage of the price discrepancy and assuming that these securities actually return back to true value. Last but not least, the fourth is actually on trading. Trading is actually a very interesting strategy whereby fund managers like ourselves, we also invest into trading approaches using either quantitative and buying into very highly liquid instruments. So in a nutshell, there are also various types of hedge fund strategies depending on client's profile, experience, etc. And I think, Cheryl, your question also was about when should investors look into investing hedge funds, right? Mm-hmm. So, or alternatives for that matter. In terms of when, bear in mind that for when it comes to alternative investment strategies, it comes with certain form of illiquidity, right? And if you have that tolerance for illiquidity, and also at the same time that risk appetite to be able to stomach higher risk as well, then the timing should be any time, looking at it from an SAA, TA perspective.
Thank you, Melanie. I mean, you gave a very good in-depth, view about hedge funds, but maybe now we can move on to, pin what you're doing best at, right? Lightspeed is, one of the, early investors in a lot of good startups and venture capital firms. Maybe if you could share with the audience here, what exactly is a venture capital firm? Is it something that individual investors can invest into? And on top of that, when you actually look at investing to a VC firm, for example, what do you actually look out for?
Hello? This good?
Yeah.
This one hasn't gone to lunch yet. Good mic. So maybe as a, just a quick 101, I would broadly, say that venture asset class is a subset of a private equity, right? It's just a much smaller scale, much higher risk. So I'd say I'll categorize that as underneath. So I guess people who have access to it today, at least still are, high net worth individuals, pension funds, and endowment funds, for mostly in the U.S. or firms like GIC, Temasek. So these are typical clients of venture firms, right? So just a quick 101 of what we do. And traditional venture firms invest really in technology-driven innovation companies, right? So if you just take household names that you hear today, Grab, Snapchat, Oyo Rooms, Pinduoduo, Alibaba, these were, 10, 15, 20 years ago, really companies that were just started by 2 to 3 people in a garage, right? I was an early member of Grab. 10 years ago, the company was valued at $15 million. Right, today it's trading on NASDAQ for as of yesterday, maybe $15 billion. Right, so this is the kind of journey, and essentially what we, in the top quartile, venture firms, we hope to return or give a return of about 40%, year on year compounded. And obviously, next question is then, wow, this is a great return. Why aren't everybody in venture asset class? Because there's risk, right? Many people, we only hear the heroic success stories, right? Gojek, Tokopedia, Grab, Facebook, Amazon. All these are the success stories of venture firms. But along the way, not many people know that to find even one Facebook, there were 90 others that didn't make it, make it into news. So the reason why not everyone should be investing in venture asset class is because there's risk. There's inherent risk, and the inherent risk is much higher than what you would probably get when you're investing in, maybe more later stage, private equity firms, private equity asset class, or even stocks or bond, right? So that's basically what we do, and why at least as our firm, believe it's, many people have different strategy. Like our strategy as a global venture firm is really to, go on a journey with these founders very early, and provide them with really not just money, but time and resources, and our network that we can bring with kind of the global brand to really change the trajectory, to change the trajectory of these investments or these founders, right? So so that's kind of a little bit of 101 of what we do.
Thank you, Pin. So when you're actually meeting all these VC firms, right? There are so many of them. What do you actually look out for? What stands out?
Sorry, just to clarify, as day to day, I meet founders, right?
Founders,
so they invest, So and I'll just use Endowus as an example because, again, full transparency, we're an investor in the firm, right? A few things. One is, a very, very big market, right? So I do not invest in, even the most high-flying bubble tea store, right? Like bubble tea store for me, even if they return amazing money, it is not a category that is, suitable for the venture asset class. Because for me, once again, if only 1 in 100 will make it to Facebook, then I think every time I invest, I need to really think if there is a possibility that this could, give me, could cover, I'd say, at least internally our speak, a very large surface area, right? So maybe some person starts with, I think with Endowus, they started with just helping you invest in CPF, but I need to really imagine that, one day, we'll be Sam and Greg and his team would be able to go beyond just helping people invest in CPF, but to also invest in, the money markets, and to invest in, the private equity firms, and to have conferences like this. So I guess my kind of vision turned out to be true. But that's a little bit about, what we look for, like a very big market, maybe a wedge, and then something that we can eventually, hopefully, right? If I invest a lot in consumer net companies, hopefully, 1 in 5 people on the road has the potential to use this, and as part of their life's journey. So that's number one, a very big market, and then number 2 is really just a team. There's good team, and then there's great team, right? I think a great team really takes the form of, at least, again, just sharing a venture speak. You look for team and market fit. Not, every student or not every person with a HBS degree or come out of, a tech executive who spent 10 years in DBS, the best performing DBS executive. These are not necessary clear signs of good teams, right? Good teams depends on what they're working on and why they have an edge in doing what they do, right? So again, just taking an example of Endowus, I think the founding team was a great combination of someone who, like Sam, who had years and years of experience in really asset advisory and asset management, right? And he has the drive and the grit to really want to make a big difference. It's not incremental, right? It has to be huge change to the industry. And then he's teamed up with, Greg, who has spent, again, multiple years, right? Came from Hong Kong, and his family, is really has deep knowledge in, wealth management. He spent a lot of time in Grab and really understand kind of how to move the really bits together to make this work, right? And I think that combination, at least for me, is a very powerful combination. It's a very good starting point. The risks are still there, the work is still hard, but I think it's a very good starting point to build what I actually believe is going to be kind of the next wealth platform of Asia.
Thank you, Pin. Now moving on to, private equity 101. Right, Dominic, you're a partner in TPG where you run many PE funds. But could you maybe break it down a little bit for us to let the audience here understand a little bit more about what exactly is private equity? It tends to be a little bit less opaque in terms of disclosure when it comes to investing into companies as compared to, I would say, investing into a public equity. Right? So how can clients or investors think about this? And also we hear, I know a lot of questions in one, we also hear this term GPLP very often. Could you just, explain to us what that is about?
Sure. I guess a few topics in there, so I'll try to take it bit by bit. As Pin said, VC is really a subset of private equity, which is a subset of the broader alternative asset space. And the private equity industry has been around now for probably 50 years or so. It just wasn't called private equity when it first began. It was a group of people who would spot an investment opportunity, usually something that wasn't available in the public markets, and then they would gather a group of investors together to make that investment. And so to be able to make large investments, it meant gathering money from usually pension funds, possibly insurance companies, who had the ability to deploy large amounts of money. As the industry has grown and matured, it's come to be known as private equity. And these days, as well as gathering money from pension funds and insurance companies still, we're also gathering money from sovereign wealth funds, but also wealthier individuals, and increasingly through various different means. Also, there are ways for people to access private equity at even smaller check sizes. What we do, which is different to what Pin does, is I would love to be able to generate 40% returns, but the returns are probably more like 20 to 25%. But the reason for that is we're taking less risk, and in taking less risk, we would really be investing only in the best of the companies that graduate from a VC firm. And if I could take an example that you might all be familiar with, which is Property Guru. It's now a listed company on the New York Stock Exchange, but when we first invested in that was about 8 years ago. Before we invested, various VC firms have invested in the company, so it had sort of proven its ability to make money. By the time we invested, we helped the business expand into multiple markets, and now it's a profitable cash-generating company that's available for people to invest in the public markets. And so it's a good example of how a business can graduate from VC to private equity to public markets. The other reason I raise that example is what we're trying to create for investors is things that they can't necessarily access in the public markets. People are not going to pay us fees to do something that they can go and do in the public markets by themselves. I think this is a little bit where the transparency point comes in as well. And I think we often hear it that private equity is not a very transparent investment category. And I think that comment is fair in some respects and unfair in others. And what I mean by that is if you invest in the public markets, you get a fair bit of information about how your company is performing every quarter or every half year. They will publish quite detailed financial statements. The question is, though, what are you going to do with that information? You can only make a decision to continue to hold your investment or possibly to sell your investment, but there's really no ability to influence what the company is going to do, at least as an individual investor. When you have a private equity manager and you invest with us, from where we sit, we get a tremendous amount of transparency into what our companies are doing. So we would usually sit on the board of the company. In some cases, we would control the company. And the level of detail that we get is much, much more than what you would get as an investor in a public company. And so we get a tremendous amount of transparency. And we think a lot before we make an investment in a company about how is the governance of that company, how is the quality of their own information, how transparent are they with us when we're considering making the investment. So we, in a way, you're sort of outsourcing that transparency to us. The reporting that we give back to our investors is on a portfolio basis because we're putting together a portfolio of companies and we're very transparent about our own returns. But admittedly, the amount of information you get about each individual company will be less than if you're investing in the public markets. I think the last of your questions was around sort of a GP and LP, which is a term that you hear quite a lot. And the acronyms mean general partner and limited partner. That probably doesn't help answer the question though. And these acronyms go back to the very beginning of the industry when these clubs were coming together to do deals, and they were typically structured as partnerships. And the best way I could sort of simplify it, I think, is think of the general partner as the manager and think of the limited partner as the investors. And really what it means is the general partner has the discretion as to when to buy the investment, how to manage the investment, when to sell the investment, and the limited partners or the investors enjoy the returns from the investment.
Thank you, Dominic. Now I think the most important part is how do we apply what we have learned from the panel here, right? So Jeremy, we probably need your help there. So as an individual investor, what are some of the learning points that you have made throughout your investing journey, especially when it comes to alternative investing? What sort of risk do you think all of us should be thinking about, and how do we view risk reward when it comes to investing in such a space?
Okay, great. So the title of this talk is Alternative Investing 101. So I feel like I am the 101 here. I'm the basic guy, right? But I can share quite a bit about my personal experience investing in alternatives. So I've done personal investing on the side, on a seed stage, angel investing. And I've done this in tech startups, in apps, like what Pin does. But clearly, at that time, it was so exciting. I got involved, and I got friends to did a fundraise, and I went to invest, and I was very involved in go-to-market strategy, what you should do. So it's an app for like food. It's something like Hungry Go Where at that time, many years back. But guess what? After a while, it basically died. So I lost all my money, and so did my syndicated friends that I brought into the investment. So that was my first experience in, I say, early stage investment. Later on in life, I was approached to do a Series B investment into a solar company. So I was like, yeah, okay, this sounds pretty interesting. Solar, renewable, many years ago as well. So it's a Singapore company. So I put in money, I invested. This time round, I was smart. I didn't get anyone to join me, right? I didn't want to bear the risk. So I did an investment, and this one turned out well. I actually made money. So I made about 2.8 times money and money over 5 years. The exit was that this company was via a trade sale to a Spanish company, recently reported in a newspaper. So that was pretty nice. So I had my first taste of a PE-type investment, right? I would say growth equity. And from my experience, I enjoyed the investing experience, but I felt like the key takeaways is that there's a lot of concentration risk if I'm just doing it on my own. So I put in one asset or one bond, you're really exposed to that particular underlying asset and its performance. And if you don't have time to track it, I think your time is better spent, focusing on your real job, right? So for me, that was one. And I guess in investing in this asset class as well, a lot of the times it's about access. So I was very interested in hedge funds and also PE, but a lot of the funds are not open to, I guess, retail or AI, and the fund requirement is quite high. It's a very high capital outlay. So even for the Series B investment that I did, it was fairly lumpy capital outlay. And that, again, increases your concentration risk based on your own personal portfolio. So I feel like these challenges with the world today and the technology that's available can be mitigated by having a platform where I can go in, and the minimum investment size is lower, so I get to see what all the choices are, and I can spread out, right? Like what was mentioned earlier about the 4 buckets. I can put a bit in PE, I can put some in private credit, and maybe some in VC, and I can tailor that. Back then, many years ago, when I started this investing journey, we didn't have that option. And so I just dabbled my hand in it. And I guess also in alternative asset class, I did dabble also in crypto. I managed to do some DeFi, yield farming, staking coins. I also got burned, right? So right now, I mean, personally, I limit my exposure to this asset class to about 5 to 8% of overall portfolio, but it is an exciting asset class. Right now, I am doing a bit more research personally on the private credit space. I was just asking ChatGPT yesterday some questions. So still learning, still enjoying the journey, and clearly I think that the panel here have hopefully shared much more than my basic 101.
Thank you, Jeremy. I think you had some foresight because one of the second top voted questions was actually about cryptocurrencies. And I think you adequately answered the question. So I'll go to the top most voted question, and undoubtedly it's about fees, right? So in the alternative space, especially hedge funds and also private equity, the fees tend to be higher than as compared to buying an ETF or buying an index tracking fund. So comments from the panel in terms of are these fees warranted? Dominic, looks like you're the best person for this question.
It depends on the returns. So look, I would look at it as what returns do you get as an investor, and if you're in a top quartile private equity fund, it should be more than a 20% return even after fees. It will be higher than that, obviously, for a VC fund. In our industry, there are two parts to the fees. There is a percentage of assets under management, and usually the bigger the fund, the smaller that percentage will be. But then probably the more important part is what we call our carried interest, which is a percentage of the profits. And that's actually the bigger piece of the fees, and it means that we're very well aligned with investors because we only get those fees if the investments are profitable, usually over some sort of hurdle return, which I think is different to perhaps a more passive investing style where the incentive for the manager is to grow AUM as opposed to how profitable that AUM happens to be.
Thank you, Dominic. I think the next question, maybe Melanie, if you could help us out on, is about asking what are additional benefits such as hedge funds? How does it provide long-term, help to achieve long-term goals for retirement, let's say? Does not need to be particularly hedge funds, can be also private equity or any of the alternative space.
Sure. Maybe I can touch a bit about some of the trends that we're seeing from a UBS EM perspective. And we've really seen an acceleration in terms of clients allocating to alternatives. And we've recently also commissioned a survey to understand what are our clients and what are investors thinking of. And I think the common driver behind the decision to invest more into alternatives has been diversification. That's really the free lunch here, isn't it? In terms of the ability, if you diversify across not just traditional bonds, and equities. Now, so within the alternatives strategies, the type of alternative strategies, what we've really seen also is or more into alternative mutual funds. So the more liquid type of strategies as well, that's actually has been also taking up a lot of interest. And to that point also, I was very intrigued by the survey results that fellow speaker Gayton from Amundi showed earlier, where he actually showed the chart in terms of investors' appetite for alternatives. And I was particularly honing in on that bar chart that actually showed that high net worth investors versus retail investors, and the allocation of alternatives of retail investors actually is at 0, if I'm not wrong, whereas compared to high net worth individuals, it is actually at a significant, I think it's a 35 or 36% allocation to alternatives. So that actually, again, it goes back to what we commonly see, right? Many jurisdictions actually limit the availability of alternative investings to retail investors. It's typically more catered towards the institutional investors or even the accredited high net worth individual investors. And that's because of also the higher risk element to alternative investments. However, in Singapore, we've seen that actually within the asset management landscape, alternative fund sales actually has grown significantly in the past years vis-a-vis traditional. All right, and my point here is that despite the overall more education about alternatives, I think retail investors have actually only started because traditionally all this while alternative investment has been actually more suited and more catered towards the high net worth and institutional investors, right? But back to what we're seeing also as well in terms of the trend that's dominating diversification, and as AIA CIO earlier, Chun Yan, she mentioned, right, with the fragility and the macro uncertainty likely going to drive markets, we will likely see more and more interest in this space as well, because alternatives do provide a better return stream as well, uncorrelated, of course, being risk aware about that aspect as well. So I think this is a trend that will continue to stay.
Thank you. I think we'll probably take another one or two last questions from the audience. And I think Pin, you can probably help us out on this because it's very specific to startups. What are the financial metrics to use when evaluating investing in startups, especially when they are still not profitable and still cash flow negative?
Good question. So I think it really varies, from business to businesses, right? So, everybody fundamentally wants a profitable company, free cash flow, that's hopefully very, very scalable, at least in venture asset class. And so the journey to that obviously has different drivers, right? If you are a wealth tech company, then it could be driven by the number of customers that you are, adding on year, day to day, month to month, right? You're also looking at, AUM per user, right? So how much are individuals putting onto your platform, and is that growing over time? If you're an e-commerce company, obviously, then there's a whole different metrics, right? Like how many merchants have you onboarded? How active are your customers? How many of them are, profitable customers? How many of them are, loss-making customers? And you can use these underlying metrics to project towards sort of hopefully 2-3 years or 10-year time frame as you think about it, to kind of keep the company focused, at least, all right, on a path that will hopefully create a lot of free cash flow in a highly scalable way, right? Again, this is not about a business that will take 20-30 years to get to $20 billion outcome, right? Our fund cycle, our investment horizon is hopefully in 10 years, right? In 10 years, I find, I invest something, and hopefully 10 years, it becomes a grab, right? So that's a little bit of how, we think about it, and what are the drivers that we are looking for in the early days, and then what we hope for, right, in the later days. And I would also say that a lot of the metrics in the early stage startups are qualitative. Again, I say this because a lot of time is really about the founder. So we take a lot of time to do founder references. This is like 2 hours of me spending time with them and really debating on, the market, the product decisions, the trade-off that it's going to make. And these are like, I would say, qualitative measures. So I would just go back to, Jeremy, you made a really good point about why I think the difference between Jeremy and myself and Dom is not that individually we are any smarter, right? But actually the difference between, three of us is actually between Dom and myself have a large team really behind working for us to give us, information, right, sourcing, and to give us time to evaluate and be with the founder and and understand the problems and how kind of help them problem solve, and eventually also to help them exit, right? So this is really the only reason why I actually, for example, don't invest in any other funds in my own asset class, because I believe my firm, Lightspeed, is top quartile firm. But when I invest, I obviously have an asset allocation that is in growth equity, in bonds, in stock markets, and actually a lot of time, and that's why I think Endowus has been such a crucial part of my financial journey, is because I believe in any other asset class there is a Dom that does better than this. There's a there's a Dominic that does it better than me, and I'm sure if I have to invest, I'm not familiar with what you do, Jeremy. If you are the top quartile at what you do, I will also allocate my money accordingly. So that's really the philosophy, or at least my personal view on why we should, access certain funds, or get advice from certain people, right? It's like, if everybody can teach Chinese tuition, but you're not Barry, like go to Barry's, right? If you want good Chinese outcome. So that's a little bit about at least my personal, investment philosophy or asset allocation philosophy.
Yeah. We've actually come up to time, but I will take the last question. Just bear with me. It's asking about what alternative investment options does Endowus have? I just have to answer this question, right? So we do offer hedge funds and private markets, funds on our platform, and they tend to be semi-liquid in nature. We do have offerings for accredited investors and also for our retail clients. So please do approach the client advisor team. They're all around the floor and outside. And also please approach our investment office folks. They are also here as well. And so on that note, I just want to thank you all, the panels, for all your insightful, comments and views. And thank you.
Thank you. Thank you very much once again to our wonderful panel and to all the insights that you received. I just want to take a moment to also thank all the staff, right? Who've been working so hard to keep us going and doing all these things behind me while I stand on stage and talk to all of you. I'm so sorry if I made you nervous. I sometimes have that effect. Here you go, madam. Thank you. Thank you. Wow, we've had such a full day, right? Lots and lots of insights. We really, really hope that we've informed, we've inspired you, we've deepened your already great knowledge. I'm going to just stand on stage and applaud all of you for being here, for all your fantastic questions. I've learned so much, just as much as I've learned from the experts on stage. You guys are experts all in your own right, and you've really informed me. I'm going to go home and read through all of my crazy notes and try to make sense of them. So thank you so very much for being with us today. You're such an engaged and such a self-informed audience as well. It's really wonderful. If you are actually planning, and if you're not already a new client with Endowus or existing client, if you're planning on signing with them, they have a wonderful little promotion going on where you get, in Singapore, a $50 fee credit. If you're in Hong Kong, who is watching us virtually, that's 300 Hong Kong. So talk to the client advisors. They're in the room. They'll be outside. Of course, you can use the app and get involved with them. Are you standing up because you're going to say a few words? You're coming to do that. Okay, I thought maybe I missed out something. Okay, wonderful. Okay. So that's me with that part of it. Final lucky draw. Yes. And it's none other than a really, excuse this language, but a really big-ass TV. And we're not going to give you the TV itself. We'll give you a little card if you win it today. So it's a Prism Plus 65-inch TV worth $2,999. Spin that wheel. Yes. Come on, don't hold off on. Joyce Jing Wen. Joyce, are you here in the room? Joyce, come on up. Sam, if you would, come on this side. Joyce, sorry. And Sam is going to give you the prize. Please come here into the center. You are our big grand winner for the day. Please pose for a photo. Enjoy your TV. Wow. How fantastic, Sam. Thank you very much. That's the Chairman and Chief Investment Officer, Sam, of Endowus, has just given away the prize. Well, that's it, guys. Thank you so much for being here. Thank you to all of our panelists throughout the day. I want to thank the team at Endowus who have put this wonderful occasion together today as well. All the contributions and all the discussions, our deep appreciation of everybody that came today as well, and everyone that joined us virtually. Your active engagement has made this WealthTech conference truly exceptional, and we really hope that you walked away with lots of fresh insights and new knowledge. It's been a pleasure to be your MC. Have a wonderful Saturday and Sunday, and happy investing. Thank you.